Okay, so good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Is my voice audible and the PPT is visible? Yes, okay, thank you. So we are going to do chapter interest rate management. So what is this chapter is all about? Frequently asked questions in latest exams for sure. Some applications of previous chapter also will be there, so just be extra careful. Interest rate management is all about managing interest rate risk. So what is interest rate risk? Movement in the interest rates. Does interest rate fluctuate? Yes, that's called as typically we use something called as LIBOR, London Interbank Offer Rate. The rate at which the bank lend and borrow between themselves, London Interbank Offer Rate. In India, we have Mumbai Interbank Offer Rate. It's like a market rate. It's like a market rate. Just like the market price will be there for the shares, we will have the market rates for the interest rate that's called as LIBOR. You typically useful if you take a fluctuating rate. You remember even in bond valuation we discussed, you can take a fixed rate loan, a fixed rate bond, or a fluctuating bond, variable rate. If it is fluctuating bond, variable coupon bond, that means the coupon will be paid as per the market rates. You need a benchmark for the market rates. That's called as LIBOR. And RBI will not fix it. No central bank will fix it. It's determined by market force, demand and supply. Just like market price, in case of shares, government will not fix it, share price. Similarly, LIBOR is out of demand for money, supply of money, it's market rate, London Interbank Offer Rate. So what is interest rate risk is all about? These fluctuations. For whom does it matter? For borrower, he is worried about increase in the interest rate risk, and investor is worried about decrease in the interest rate risk. Obviously, right? The borrower who takes loan or who wants to take loan, if interest rate increase, he has to pay more interest. His risk is increasing the interest. As an investor, as a depositor, I am worried about my inflow of money. If interest rate reduces, my inflow will reduce. So my risk is about decrease in the interest rates. But examination problem mostly will revolve around borrower, because as an investor, we really don't discuss here much. We discuss in bond valuation. So this chapter is mostly about from borrower perspective. From an institution level, invest depositor, I mean, like bank, they have to worry about their asset liability management, deposit assets, deposit and liability. But as far as individuals are concerned, corporations are concerned, you're always worried about the borrowing. So examination problem will be focused on borrower related problems. It might be prospective borrowers, prospective investor. That is, a project is coming up after 6 months. So you're going to borrow after 6 months. That's what this situation also applies. Instruments, we are going to learn forward rate agreements, interest rate futures, IRF, interest rate options, IRO, and interest rate swaps. In the interest rate options also, we have so many other varieties. These are the broad varieties that we have to understand in this chapter. Let's take one by one. The first is forward rate agreement. As usual, first I would like to give you the overview of the entire chapter, summary, theory, some and revision purpose, whatever you call it. So first we'll understand each instrument, how does it function, how to calculate the numbers, and then you can apply it in the problems later. Okay, coming to forward rate agreement. It's an agreement entered today for settlement at a later date. The later date is fixed today and the rate is also fixed today. A normal terms only. We have discussed this in shares, forward contracts. We have discussed it in foreign exchange. Like exporter will enter into forward sale contract because he will receive the dollars at a later point in time. For him to sell the dollars, he needs a forward sale contract. Similarly, you think of a prospective borrower who is going to borrow after 6 months. Who is going to borrow after 6 months? He is not borrowing today. He is borrowing after 6 months. At what rate of interest he is going to borrow? You will come to know only after 6 months. That is uncertainty. That is risk. So today itself, you enter into an agreement with the bank for borrowing at a later date. You tell the bank, I will borrow later and give me the interest rate today itself. Let's agree upon the interest rates. So agreement entered today for borrowing at a later date, but interest rate is agreed today itself. And in this context, one special terms you have to understand, that is quotation of forward interest. Like A into B, A cross B. Some people pronounce it as A by B. A represents borrowing from today. B represents repayment from today, maturity date. I told you, forward rate agreement is entered today for borrowing at a later date, but once you borrow, you will repay the loan even at a later date. So typically there are three dates involved. One is today, then the date on which you're going to borrow, you're not borrowing today, you're going to borrow, and once you borrow, later you're going to repay. And how do you express those terms? We are doing it in the form of quotations. For example, if I write 6m cross 9m, some people pronounce 6m by 9m because 30-40 side, we say 30 by 40 side. So cross divided by, they are interchangeable terms. So if I write like this quotation 6m 9m, it means I'm going to borrow after 6 months. So this first number represents a date of borrowing and second number represents date of repayment from today. So which means how long I am borrowing, what is my borrowing term. Borrowing term is the difference between these two, which is 3 months. I hope you are able to understand. If I write 7m cross 9m, after 7 months I am going to borrow from today. After 9 months, from today, I am going to repay. So, after 7 months, I borrow. After 9 months, I repay. Effectively, my borrowing term will be difference between the two. That you understand. So, quotation A by B. So, you can say term of borrowing. If you want to remember, you can remember like this. Term of borrowing will be A or B minus A. That is date of repayment minus date of borrowing. That will be the period for which you are taking loan. Here also very interesting situation. Settlement can be on delivery basis, settlement can be on net basis. And ultimately, both impact will be same. I'll give you an example. Suppose you enter into 6 cross 9 forward rate at the rate of 12%. What do you mean by this? Today you are signing an agreement. After 6 months, you are going to borrow, let's say 100 rupees, and 3 months later, that means 9 months from today, for a period of 3 months, you are going to repay. What repay? When, how much interest you are going to repay? Interest will be at the rate of 12% per annum. For what period? For 3 months. Correct? For 3 months at 12% interest you are going to pay. Whether market increase or market decrease, you are not affected. You have to execute the forward agreement. You borrow after 6 months, you repay after 9 months. You pay interest for 3 months at the end of 9th month. That is called as the maturity date or settlement date. And that's the nature of settlement by delivery basis. We have seen this in shares also, where we have discussed forward and futures. In forward, it has to be settlement by delivery basis, but here, forward agreement, settlement can also be by net basis. Settlement by delivery basis, you understand. Delivery basis means what? You execute the contract. Market fluctuation does not matter. You go as per the market. You go as per the agreement. Market does not matter. That is settlement by delivery basis. Now, settlement by net basis means market rate will be taken into consideration, but impact will not change. I'll prove how. Now, suppose you borrow on net basis. Suppose you borrow on net basis. What is that going to happen? This, after 6 months, the person with whom you have entered into an agreement, let's say bank, was supposed to give you 100 rupee loan. The bank says, you please take loan from the market. But you tell on after 6 months, that's what it is, fixing date, the market rate for 3 months. After 6 months in the market, interest rate is 13%. You tell the person, you tell the bank, boss, I have signed agreement with you to borrow 12%. If I go to market, they will charge me 13%. Okay, then what this person will tell you, what is that extra you are paying? You are paying 1% extra, right? I will pay you 1% extra. Getting my point? You go to market, borrow from somebody else, you pay 13% interest, I will pay you 1% difference. Effectively, it comes to 12%. I hope you're able to get the point. So, difference between the forward rate and the market rate, it is called as a reference rate. The difference between forward rate and reference rate will be paid to you. Difference between forward rate and reference rate. If it is beneficial to you, it will be paid to you. If it is loss, of course, they will collect from you. And ultimately, you see, net impact is same. That's called as settlement on net basis, where it is settled in differential amounts. And one thing, keep it in mind in this chapter always. Always keep it in mind. We always talk about interest rates. Means we always talk about percentages. But the final answer has to be in rupee terms, or if it's some foreign currency, it has to be in foreign currency terms. So, from the percentage to convert into rupees, for example, in this problem, 12% is the rate of interest. If I want amount, then 12% will be applied on a particular amount, that is the loan amount, called as principal amount, and multiplied by term by 365, if it is a number of days. So, remember, in this chapter, we talk about interest rates. But finally, amount is expressed in rupees. So, from the interest percentage to go to the rupees, I need two more variables. Always look for that in the problem. One is the principal amount, loan amount, and second is the term. How long the loan is taken. In this example, 3 months. So, settlement can be by delivery basis. Settlement can be by net basis. Ultimately, net impact will be same. Purpose will be maybe for speculation or for hedging or for arbitrage purpose. You can expect problems in any of these. Mostly they will ask you hedging, but still you can be. I've seen previous questions where any of these areas may be asked. What is speculation? Again, basics of derivatives you have discussed. So if you did not understood that basics of derivative chapter, forward again, I've linked to that. Interest rate management also linked to that. So the derivative basics what we discussed is the foundation. I hope you remember it. Speculation means we take a position, long position, short position. If market price goes up, we have a position. Coming down, we have a position. So if our expectation comes true, we get profit, otherwise we get loss. That uncertainty situation, we take a bet, we have a position, we have a view, that is called as speculation. Hedging means we are trying to cover the risk. I have taken a loan, for the loan there is an interest rate risk and I am trying to manage that risk. That's called as hedging. Arbitrage means between two markets or two banks, they are not offering same interest rates. So in stock market, what can I do? I can buy in one place, sell in other place. For example, BSE price, NSE price for the same company, it must be same share price approximately, more or less. If BSE price is less, NSE price is more, I buy from BSE, sell it in NSE, and thereby the equilibrium will be maintained over a period of time. But till then, I find that price parity, disparity, till that I find that opportunity that's called as arbitrage, where there is a two different market price. In the context of interest rate management, what is arbitrage? Two banks are offering me different rate of interest. So you borrow from one bank, deposit another bank. That's called as arbitrage. Anyway, there are techniques to achieve that. It's not easy as I tell you, but let me explain one by one. Okay, now speculation. Speculation means my objective of entering into forward contract is not to cover some risk. My objective is not to take delivery. I don't want loan. I'm just playing with interest rates. I'm just having an expectation on interest rate. For example, I expect interest rate to go up. I expect interest rate to become 13%. Presently in the market, 12%. So what do? You go to a bank and say, let's have an agreement for 12%. When the market is actually, if your expectation comes true, if it becomes 13%, then what you can do? You can borrow from this and give it to market and make 1% gain. Or settlement on delivery basis, that means you will have a gain of the differential, which is 1%. So speculation means you can understand it is settlement on mostly net basis, because the amount will come to you on a differential basis. How do you calculate? Same example I'll take. So 6 cross 9, let's say you have entered into a forward rate agreement at the rate of 12%. And on 6th month, that is record date, fixing dates, on 6th month, the market rate, LIBOR rate, happened to be 13%. Now, is it gain to you or a loss to you? Okay. Now, think like this. If you go to the market, you have to pay 13% interest rate. If you go to the bank, if you go to the market, if you borrow from somebody else, you have to pay 13%. But you have already signed an agreement to borrow at 12%. So 1% saving for you. You can think like that. Or you can also think like, I can borrow using this agreement at 12%. I can give it to somebody else at the market rate at 13%. I can gain 1% interest. You can analyze in both ways. Okay, then this 12% interest, this 13% interest is committed at 6 months, the date on which borrowing takes place. But when will the payment will take place? The payment will not take place on 6th month. 6th month is date of borrowing. Payment will take place at the end of repayment, at the end of 9th months. So, if you want the interest to be paid, it will take after 3 months from that date. At the 6 months end, you fix the interest rate, you take the loan, but repayment will take place after 9 months. That is the maturity date, repayment date. Maturity period, the loan period, difference 3 months. But if you want to settle it at the end of 6 months itself, and mostly in speculation, in forwarded agreement, in net settlement basis, you will agree, you will settle it on this fixing date itself. So what you should do? You have to do a present value of 3 months. How do you calculate that? Or we can say like this, if you are bullish, that means if you are expecting the interest rate to increase, if you are bullish, then you should buy forward rate agreement. Just like the shares. If you are bullish, you should buy shares. If you are bearish, that means expecting the interest rate to come down. If you are bearish, you have to sell forward rate agreement. Okay. Now, mostly it will be on the buy forward rate agreement. Let's focus on that. So, how do you calculate the amount on net settlement basis? In my example, market rate is 13%. You have taken a forward rate at 12%. So, 1% is what will come to you. So reference rate is 13%, forward rate is 12%. 1% will come to you. I told you from the percentage to come to the amount, you need two things. One is the principal amount, that is loan amount, and multiplied by the term of the loan. Why it's called as notional principal? Because when the settlement on net basis, you don't really take loan and you don't really repay loan. Both will not happen. So, but for calculation purpose, we need that base, like a lot size, you can say. That is what is called as notional amount, because actually loan is not taken, loan is not repaid when settlement is on net basis. And as I told you, this amount will come at the end of 9th month. And if you want today itself, that is at the end of fixing date itself, then you should do present value. So divided by 1 plus r at market rate of interest into term loan. I mean term of the loan. Term loan means term of the loan. The same term into like 3 by 12 months or 60 by 365 days, whatever the time value of money that you have to adjust. So this will give you the amount to be received on speculation basis, on net settlement basis. So you take a position at 12%, market rate 13%, you say 1%, as per your expectation, market rate has gone up. But you expect 12%, market rate has come down to 11%, it has gone against your expectation, you will lose 1%, you have to pay out of your pocket 1%. Okay. Now, borrowing, hedging means you have a borrowing, and in the borrowing, you want to protect the interest rate, so you take a forward rate agreement. So, there is one borrowing plus forward rate agreement, or in the forward agreement only you borrow. That's called as hedging purpose. Speculation, you have borrowing and investing. That I need to give example to make you understand how it works. I'll give a small example for this now. Speculation purpose, hedging purpose. Uh, I'll give a small numerical example, but if you have any doubt at this point in time, you can get it clarified. So in the examination, sometimes they might give you borrowing rate as well as deposit rates. Just be careful which one to be picked. Mostly it will be from borrowing rate. So whichever is higher you take. If it is, sometimes they'll give you different quotations, 3 by 6, 6 by 9, 0 by 6. So whatever is suitable for your requirement, that you have to borrow, that you have to apply. That is, are you going to borrow after 6 months, and what is the maturity period? Keeping it in mind, you have to select the appropriate forward rate. So multiple quotations can be given. You have to pick and choose the right one. Be careful there. Okay, so let me give a small numerical example. Suppose a bank is quoting forward rate like this. Forward rate is 6 by 9. It is given as 12%, 10%. That means what? Today you sign an agreement with the bank. This means today you sign an agreement. Today you sign agreement. Okay. Now can you please tell me this interest is for how many months loan you have taken? This 10% interest is payable for how many months interest? If you have to calculate interest amount, you have to multiply it by number of months. So how many months you'll multiply? It will be for 3 months. Hope you understand. The difference between these two represents the term of the loan, which means you're going to, after 6 months, you're going to borrow, and after 9 months, you're going to repay. After 9 months, you're going to borrow. After 9 months, after 6 months, you're going to borrow. After 9 months, you're going to repay. Suppose the amount, let's take amount is 1 lakh. Notional amount, notional principal, or you can say actual principal if you take actual loan. That is 1 lakh. Okay. Now, after 6 months, market rate, let's LIBOR or reference rate, let's say RR, the market rate, market and reference rate, both are same, happens to be 11%. Market rate happens to be 11%. Now, if it is on, if this is the situation given, and let's talk about a speculation purpose. Okay, if the purpose of entering into this contract is speculation. Mostly in the exam, they will not ask about speculation, but still, I'm telling you for your reference purpose. If speculation purpose, you can explain under two methods. What is speculation method? Speculation means I'm expecting the market rate to go up. Speculation purpose, you need to have a view. View is expecting for the interest rates go up. So what you did today, you entered into buy forward rate agreement. Buy forward rate means you signed a contract. That's what you remember. Today you buy forward rate agreement. Okay. And after 6 months, you are going to sell forward rate. So you can explain settlement by net basis. Let me explain settlement by delivery first. Settlement by delivery basis. That means what you are going to do. Settlement by delivery basis means after 6 months, execute the agreement. In settlement by delivery basis, contract is executed. Whereas in settlement by net basis, the contract is cancelled. Net amount, differential amount, the cash amount is paid or received. Hope you know that basics. So after 6 months, you borrow from the bank at borrow rupees 1 lakh at the rate of forward rate, execute the agreement 11%. You are executing it. And what do you do? Your objective is not to use borrowing. You're a speculator. What do? You will give it to somebody else or deposit or lend after 6 months. Same after 6 months only. Heading is after 6 months. Lend it to somebody. Lend rupees 1 lakh at market rate. You borrow at forward rate 10%. And you lend it at forward market rate 11%. You borrow as per the agreement, you buy as per the agreement, you borrow. This is the forward rates, and you lend at market rate, reference rate. And after 9 months, means 3 months later, how much amount you are going to pay interest? You pay interest on 1 lakh, 10%. For 3 months, 3 months period. So 1 lakh into 10% into 3 by 12. I think you pay 2,500 rupees. And after 6 months you lend it, you receive interest. You receive interest. How much you will receive interest? On 1 lakh at the rate of 11% for a period of 3 months. So 1 lakh into 11% into 3 by 12. 2750. And therefore you make a net profit at the end of 9 months 250 rupees. This is a settlement by delivery basis, where I borrow, I execute the contract, then I will lend in the market rate. I borrow as well as I lend, and I make a profit. Of course, if market rate goes up to 7%, I make a profit. That was my view. If market price comes to 9%, it has come down, I incur a loss. That is uncertainty. That is risk. That is a speculation. In speculation, if your view comes right, you make profit. In speculation, if your view comes wrong, you make loss. Okay. Now this is important. Settlement by net basis. Settlement by net basis. Settlement by net basis. Here what will happen? Differential amount. So after 6 months, you calculate net amounts. Net basis, you don't borrow, you don't lend. Apply the formula. Reference rate minus market rate, 11 minus 10 percentage, 11% minus 10% multiplied by notional principal, which is 1 lakh, multiplied by term, this is 3 months, and this is the amount to be received after 9 months, discounted for a period of 3 months at the market rate. So 1 plus 0.11 into 3 by 12, market rate 11%. So how much you will receive? This is the amount you receive after 6 months. So on 1 lakh into 1% into 3 by 12 divided by 0.11 into 3 by 12 plus 1. So 250 by 1.0275. I think 243.309. 243.31. Okay. This is the amount that you are going to receive after 6 months. But if I want to compare what will happen after 9 months, this is you receive. You deposit or time value of money. On this you earn interest. So what will happen after 9 months to make it comparable only? So 1 plus 0.11 into 3 by 12, you deposit the time value of money. So you multiply it by 0.11 into 3 by 12 plus 1 into 243.31. You will get 250 rupees ultimately, and you can see the ultimate amount is same under both the scenarios. Okay, so this is speculation purpose, not very important in exam, because it has only settlement on forwarded agreement. You are not really borrowing. You are not really covering any risk. The focus problem in exam will be hedging. See if you are able to understand the series of transactions. I'll give you 2 minutes. If you have any doubts, get it clarified. Okay. Now, a same situation I'm going to do for hedging purpose. Again, I'll explain on settlement by delivery basis. I'll explain on settlement on net basis. Same thing. Forward rate agreement 6 by 9 at 10%. This means today you sign an agreement. Notional principal, the same amount, let's say 1 lakh. And after 6 months, after 9 months, after 6 months, you are going to borrow. After 9 months, you are going to repay. And let's say you borrow or you would like to borrow, reference rate happens to be 11%. Same situation I'm discussing. And you repay after 9 months. That is the meaning of this forwarded agreement. Okay. Hedging purpose. Hedging purpose means you need that money. You need borrowings. You have borrowings. You have borrowings or you need borrowings. Either of the case. You have borrowings, let's say after 6 months. You need money. Need money for some projects. Let's say after 6 months. So today, again, you're worried about increase in interest rates. So today, you're going to buy forward rate agreement. This is the situations today. Okay. Now, after 6 months, again, this I'll discuss on two situation basis. Settlement by delivery basis. Settlement by delivery. And later, I'll settle by settlement by net basis. Now, settlement by delivery basis means you execute the contract, you execute the agreement. Execute the forward rate agreement, which means after 6 months you borrow. At what rate? You borrow at borrow rupees 1 lakh at the rate of market rate, which is at the rate of forward rate, which is 10%. When you settle by delivery basis, market rate does not matter for hedging purpose, and after 6 months you repay along with interest of 1 lakh into 10% for 3 months. That is, we calculate already 2,500 rupees. That's all. You're not going to invest anywhere, you're not going to deposit anywhere, you're not going to earn any interest because you need this money for your project purpose, for business purpose. Use that money, you repay the interest. 1 lakh also repay the loan. That's all. Settlement by delivery basis, nothing else. Now, settlement by net basis. Settlement by delivery basis, settlement by net basis. Here what do you do? Here you have to net settle on forward rate agreement and then you take a loan. Two separate things will happen. So net settlements on FRA, that means you cancel the agreement. Net settlements on FRA, that means like the way we calculated earlier. Reference rate 11% minus market rate 10% into notional amount 1 lakh into term 3 by 12 divided by 1 plus market rate 11% into 3 by 12. So that will give you, we already calculated 243.31. And you need the money after 6 months. This you're cancelling the contract, but you need the money. So where will you do? You borrow from the markets. You borrow rupees 1 lakh from market. And what is the market rate? At the rate of 11%. And after 6 months, after 3 months, this 243.31, you deposit. This is after 6 months. You deposit for 3 months. So 1 plus 0.11 into 3 by 12, we already calculated. This will become 250. Correct? And you borrow from 1 lakh at 11%. So you repay interest at market rate, which is 1 lakh into 11% into 3 by 12. 1 lakh into 11% into 3 by 12, you will get 2750, I think. 2750. So after 9 months, you repay interest at market rate 2750 and you get 250 inflow. This is you receive. This much you will receive. So 2750 you repay and 250 you receive. So net amount after 9 months, that is 3 months later, you will receive 2,500, which is exactly same as this number, 2,500. You see, your interest rate is hedged. So then the examination, they'll ask you how forward rate agreement is hedged through, how borrowing is hedged through forward rate agreement. Then you need not show both of them. Yeah, you can use any one of them. But when they tell you reference rate after 11% and all, I recommend you go for settlement on net basis. Because if you show settlement by delivery, answer goes in one line only, no? You can use it for verification purpose. So in examination, if the question is asked, how far interest cost is hedged through forward rate agreement, you show the calculation on settlement by net basis. So what and all will happen? Settlement by net basis, you'll receive the money, you borrow at market rate, and that borrowing have to pay interest, and the whatever amount of money you deposit, and that will be matured after 6 months. Net amount is your effective interest cost. And sometimes institute question I've seen, this 243.31, they don't consider time value of money. You don't deposit. In that case, what will be your net interest cost? 2750 minus 243.31. So you can also calculate the effective interest like that. If you assume no time value of money for the amount you received on forward agreement. And remember, if it's increased, you received it. If it becomes 9%, then you would have paid it. Inflow, outflow, just be extra careful over there. Okay, so this is settlement on delivery basis relating to hedging. Which calculation? Because one more time, I don't know, should I start last for 45 minutes again? Settlement by net basis, you are doing two transactions. In the forward rate agreement, you are cancelling the agreement. So difference between the market rate and the reference market rate and the forward rate, the difference you are getting, that is settlement on net basis. 11% minus 10%. Whereas in here, you need the money, so you go to market and borrow at 11%. So effectively, if you think on gross basis, without this calculation, two transactions happening. I'm settling the forward rate agreement on net basis. Means earlier I've entered into 10% agreement and now I'm cancelling with 11%. So 1% I'm receiving. That is net settlement. And I'm going to market and borrow the money at 11%. So 1% in the forward rate net settlement, 11% I'm paying in the market rate. Effectively, it comes to 10%. That is percentage explanation. This is rupees explanation. So two transactions are there. So what you did today and what you did after 6 months, you entered into forward rate agreement. After 6 months, you cancelled it. That is what the difference. 11 minus 10, you got 1% on net basis. But you want money also after 6 months. So you're going to borrow from the market at 11%. So 1% you received, 11% you are going to pay. Of course, you'll pay after maturity period only, but percentage terms, 1% you receive on cancellation, 11% you are going to borrow from the market. Effectively, your interest cost should come to 10%. That is the percentage terms explanation. What I have calculated here is amount rupees calculation, but in the exam, you have to present in rupees only. Okay, I hope if you have still any doubt, you can get clarified. Okay, so now I'll go for last situation, which is quite tricky. In fact, this is called as in forwarded agreement. How you can do uh, arbitrage. This is a very interesting situation. Arbitrage in forward rate agreement. They are not asked very repeatedly, but one or two times here and there they have asked. So you should be careful regarding arbitrage in forward rate agreement. And you know, arbitrage means you need two markets, or I here at least I need two instruments. Okay, let's say one instrument is Libor rate, market rate. So let's say two instrument we require. Let's say market, or let's say Libor, like a debenture, you can say. You can say debenture. Let's call one instrument as debenture, which is fluctuating. Let's say market rate. They are going at market rate, Libor rate. And other is bank is offering forward rate agreement. Okay. Now debenture, if you take the loan for 2 years, 2-year loan, a debenture is going to cost you, let's say, 10% per annum. If you take 2-year loan, and if you take a 3-year loan, let's say they will charge you 12% per annum. Okay, and bank is offering forwarded agreements 2 by 3. This is years, okay, 2 by 3 at the rate of, let's say, 15%. Okay, now this is the basic data available. Debenture is having market rate LIBOR. If you take a 2-year loan, it will cost 10% per annum. 3-year loan, it will cost 12% per annum. And bank is offering 2 by 3, 15%. You know what you should do? You have to calculate theoretical rate and actual rate. This 15% is actual rates. And using these two, 2-year loan, 3-year loan, you have to calculate implied rate, or you can calculate a theoretical rate, theoretical forward rate, or implied forward rate. How do you calculate implied forward rates? Okay. Do you remember we have discussed this in again bond valuation chapter? Now, if I take a loan for 2 years, how much interest I will pay? 10% per annum. So if I take a loan for 3 years, how much interest I will pay? 12% per annum. So effectively, if I increase my term by 1 year, how much extra interest I am going to pay? What do you think? If I take loan for 1 extra year from 2 year to 3 year, how much extra interest that I have to pay? It seems it is 2%, but it's not 2%. Why? Because this is 12% per annum. If you take 3-year loan, you have to pay first year also 12%, 2% extra for first year also. Second year also 2% extra. That means second year also 2% will come extra. 12% you have to pay, 2% extra. And third year you pay 12%. So total you are paying 16%. Do you understand? Or other way of calculation, 2-year loan 20%. So if I do simple calculation, 10 into 2, 20%. And 3-year loan 12%, 3 to 12, 36% total basis. So 20% here, 36% here. So for 1 year extra, effectively I'm paying 16%, 2% extra for first year, 2% extra for second year, and 2% extra for third year. That's what is 16% coming to. Hope you're able to follow it. But this additive model, this is yield. I need YTM. I don't know whether you remember this method. 1 plus forward rate of year 1 into 1 plus forward rate of year 2 into 1 plus forward rate of year 3 is 1 plus YTM of year 3 whole cube. Multiplicative model. I explained logically by additive model, but multiplicative model I do everything 1 plus 1 plus. I hope remember this. If you don't remember, I can't really help. You should go and refer it. I tried my level best to recap it. And 1 plus forward rate of year 1 into 1 plus forward rate of year 2, that is nothing but 1 plus YTM of year 2 whole square. So this 2-year loan is YTM of year 2, 3-year loan is YTM of year 3. So this will be 1 plus 0.10 whole square into 1 plus forward rate of year 3 is 1 plus YTM of year 3, 12%, 0.12 whole cube. So what is forward rate of year 3 will be 1.12 cube divided by 1.10 square minus 1. So which will be 1.12 into 1.12 into 1.12 by 1.1 by 1.1 minus 1 into 1.16109, 0.1611, or 16.11%. I already told you approximately how 16% comes. 12 into 3, 36. 36 minus 20, differential 16%. Approximate number I already told you. But anyway, what was the objective of this calculation? If I take 2-year loan And if I take 3-year loan, which means there is a implied rate of 16.11. Incremental rate, you can also say incremental rate. Incremental, implied means 16.11% is the implied forward rate for third year. That is 2 by 3. After 2 year up to third year is 16.11%. This is theoretical rate 16.11. And what is the actual rate? 15%. Those two rates are not same. When the rates are not same, there exists arbitrage opportunity. And what is going to be arbitrage process? You borrow at a cheaper rate, deposit a higher rate. So arbitrage is going to be you borrow at a forwarded agreement. You borrow at forward rate agreement and you deposit at this what our implied rate. Deposit at implied rate means this debenture. Deposit at debenture. Deposit at debenture. I'm going to show you a series of transactions, but this is how you calculate the implied rate and compare it with the actual rate. Okay. Hope you're able to take down till here. Now we have to tell the arbitrage process. Overall process I told you, like underpriced means buy, overpriced means sell. But I should list out one by one transactions. Okay. Now, how to create the arbitrage process. Okay. So we have debenture, one instrument, and we have this bank forward rate, bank rate, another instrument, bank borrowing, whatever it is. So 2 year and last 1 year, total 3 year, and that's what is this forward agreement comes to, a forward rate applicable for third year. Okay, and what is that we have created with the forward rate agreements? Just 1 second. Okay, rather than instruments, I will tell you the borrow and deposits. That's important. That's the arbitrage process. So let me give the heading arbitrage process. So where will you borrow and where will you deposit in 2 year and in 1 year, last year, third year. Okay, so what we have identified now, you are going to borrow in forward rate agreement. When are you going to borrow? You sign an agreement 2 by 3. What is meaning of 2 by 3? You borrow after second year, repay for third year. So borrow, that is going to be your actual forward rate agreement. Actual forwarded agreement, that is what you are going to borrow. So what you are going to do? You are going to deposit. This is bank. What are actual forward rate using bank? Actual bank forward rate. That you fill. Remaining place you create the whatever debenture, that MIBOR debenture, fluctuating loan. You write debenture. and debenture. So what you are doing? First you write where I am doing actual thing, because my forward rate agreement is 15%, employer rate is 16%, the forward bank happened to be cheaper rate. So what do you do? In the actual place, that is what actual bank rate, that is cheaper, so you write in the borrow, remaining you write debenture. I hope you are able to understand. So what you are doing, you are depositing in the debenture for 3 years, your debenture borrow for 2 years. So artificially, you are creating the deposit for 3 years last year, and for that source coming from the actual forward rate. Okay, so what transactions you are doing today is in the debenture you borrow for 2 years. You borrow for 2 years. Let's say rupees 100. You borrow rupees 100 for 2 years. Now, arbitrage means I start with zero money, so I have to start with borrowing. I borrow for 200 for 2 years, and I am going to deposit same debenture rupees 100 for 3 years. So for 3 years. So after 3 years, this deposit will be matured. I'll repay borrowing, but borrowing has to be repaid after 2 months itself, after 2 years itself. So what do? You borrow, or you enter into forward rate agreement. Enter into forward rate agreement with the bank 2/3 to borrow. To borrow. So today is that, and after 2 years, what will happen? You borrowed rupees 200, rupees 100 for 2 years. This will be repaid. How much you have to repay along with interest? 100 into 1 plus, what is the rate of interest for 2-year loan? 10%. So 0.10 to the power of 2. So you have to repay hundreds into 1.1 into 1.1, 121. You have to repay 121. Where will you get the money from 121? That money comes from forward rate agreement. So you borrow using forward rate agreement at 121 rupees. And this deposit will not come now. This deposit comes only after 3 years. So after 3 years, this is, I'm only explaining by settlement by delivery basis. This you need not think about settlement by net basis. So this 121, this closed, borrowing 2 months, 2-year debenture closed, borrowing 3-year 121. So 121 into, what is the forward rate? Committed 15%. So 121 into 1.15, 1 plus R. I'll write 1 plus R. 1 plus 0.15. 139.15. And this deposit will be matured. This has to be repaid. This 139 should be repaid, and this deposit matures after 3 years. That is 100 into 1 plus, what is that rate? 3-year deposit, 12%. So 1 plus 15%. This is not 12%, this is 15, yeah, 12%, correct. Borrow 121, yeah. This is 12% deposit for 3 years. So 100 into 1.12 into 1.12 into 1.12, 140.49. This is what you will receive. So effectively, net arbitrage profit, arbitrage proceeds, 140.49 minus 139.15, you will get 1.34. So for every 100 rupee borrowed, you will get 1.34. Okay, so this is the arbitrage process. I'll explain once more. What and all the arbitrage process will involve? You have to first take the actual forward rate. and compute the implied forward rate. Like in this case, the actual forward rate is 15%, implied rate is 16%. There is arbitrage opportunity. And you borrow at a cheaper rate. So in the bank, the actual forward rate you borrow, other instrument, debenture, you deposit. And how do you construct the transaction easily? You write like this: 2 year, 1 year later, then borrow, deposit. First thing you have to fix is what you're doing in the actual rate, actual transaction, actual forward rate. Actual forward rate in the third year. After 2 cross 3 means in the third year you are borrowing. Remaining everywhere you write debenture, which means today what are the transactions you're going to enter. Today you borrow debenture for 2 years. Today you deposit debenture for 3 years. And where do you repay this 2-year loan? For that you enter into the forward rate agreement. So after 2 years, in the third year, you borrow from the forwarded agreement, you repay this debenture is closed. Then this loan will be repaid along with forwarded interest. That's what I did. 120 into forward rate of 15%. The total will be 109.15, and this debenture deposit matures after 3 years, so you will get the ultimately arbitrage profit. So writing this table is the tricky one, which is again not available in any textbook, not available in any other academy. This table, what you write, is the shortcut for you to build the arbitrage transactions. The table, the 2-year, 1 year, borrow deposit, you fix the actual, remaining everywhere, you fix the another instrument. Okay, I hope you're able to get it. This is what is forwarded agreement under 3 scenarios: speculation, hedging, and arbitrage. Hedging is very important from exam point of view, that angle. Arbitrage also very rarely asked. Speculation, I don't see them asking. Anyway, so this is what we have in forward rate agreement. Just one scenario. If the forward agreement was not 15%, if it was 17%, what you would have done? If it was 17%, you would have deposited at actual forward rate and borrow at an implied rate. How do you create borrowed implied rate? This actual will be deposit. So here you are going to write deposit at 1 year forward rate, bank. Remaining everywhere, it's going to be debenture. 3 years you borrow, debenture you deposit 2 year. Just the opposite. I'll write it for you in case if you want just a thing. So you write like borrow, you deposit, you write 2 year, you write 1 year, and because I told you it happens to be 17%. So forward agreement 17 is beneficial to be deposited. So deposit, this you fix it first. Deposit actual forward rate of bank. Bank quoting the actual forward rate is ideal for deposit because it is higher. Remaining everywhere you fix debenture. Remaining everywhere you fix debenture. So debenture you borrow for 3 years and debenture you deposit for 2 years. And I hope you're understanding what is the implied rate. You borrow for 3 years and deposit for 2 years. You're creating implied borrowing for 1 year. You understand? It's like credit 3 years, debit 2 years, net credit 1 year. You borrow for 3 years, you deposit for 2 years, net borrowing is for 1 year. That's the implied rate you're creating. Actual forward rate deposit, implied rate you're borrowing. That's how you build arbitrage process. Anyway, hope you're able to get it. I'll go further. Okay. Next, what we have is interest rate futures. Short form, we call it as IRF. Futures, we discussed in shares, derivative chapter. Futures, we discussed in foreign exchange futures, currency futures. Here we have interest rate futures. So it's derivative where underlying asset is the rate of interest. Regular features, lot size will be there, expiry rate will be there, month end, and net settlement basis, square of basis, mark to market, initial margin, all those things will be there. That is standard feature. But what is a special feature associated with interest rate futures? The settlement amount will be sale price minus purchase price into lot size into term of the contract. And one more point, the pricing of the interest rate future is expressed as a bond price. So usually they will give the problem. If it is not given, the bond price will be 100 minus rate of interest. This also can be used for hedging purpose, speculation purpose, arbitrage purpose. But what is most important is again hedging. So we'll discuss only with respect to hedging. Exam also, if at all they ask IRF, it will be only with respect to hedging. So how this IRF will be asked? For example, today you enter into a transaction and later you exit. Let's say you buy and you sell. When you buy, interest rate happen to be, let's say, 8%. When you sell, interest rate happen to be 6%. This is example purpose. So I have to tell I buy at 8%, I sell at 6%. No, I don't want to express in percentage terms. I'm expressing it as bond price. How do I express as bond price? Normally, if nothing is given in the question, you should do 100 minus rate of interest. 100 minus 8, 92, which means I have purchased at 92 rupees. IRF, though underlying asset is interest rate, it is expressed as a bond price. 100 minus rate of interest if the price is not given in the question. And later, when you sell at 6%, that means what will be the bond price? 100 minus 6, that is 94. So you purchased at 92, you sold at 94, which means you made a profit of 2 rupees. But again, it is not 2 rupee profit, it is 2% profit. It is 2% profit. So 2% profit means you have to convert it into rupee terms. So I told you in the basics of this chapter, how do you convert the percentage into rupees? The percentage I have to apply on two things, a notional principle and the term. That's what I told you. So the profit here 2%, sale price minus purchase price, 94 minus 92, 2 is not 2 rupees, 2% on lot size will be like a notional principle and into terms of the contract, like 3 months loan, 5 months loan, 6 months loan, like that, 5 by 12, 3 by 12. And of course, you also multiply it by number of contracts. So that's what is the IRF calculations will be about. So sale price minus buy price will give you rupees, like bond price, sale price minus buy price, but it is not rupees, it is actually percentage. Because bond price effectively is calculated as 100 minus rate of interest. So what do you do? Sale price minus buy price, that is your percentage, profit or loss. On that you multiply it by lot size. On that you multiply it by terms of the contract. You get the profit or loss in rupee terms. And of course, you multiply it by number of contracts also. This is per contract. You multiply it by number of contract. Okay, mostly IRF is for hedging purpose. So what is the transaction you carry out in hedging purpose? Take a look at this. Please observe. When rate of interest increase, what will happen to IRF? See, if rate of interest 6%, 100 minus 6, 94. If it becomes 7, 100 minus 7, 93. When rate of interest increase, IRF reduces. That is a nature, right? A bond valuation chapter. There is an inverse relationship between the rate of interest, that is YTM, and the bond price. One increases, other decrease. So here, as a borrower, I told you, if at all problem comes in this area, it will be borrower position. So I'll explain only from borrower position. Now, borrower is worried about increase in the interest rates or falling in the interest rates. The borrower risk is increase in the interest rates, and if interest rate increase, what will happen to IRF? Inverse relationship. IRF will reduce. Now IRF reduces. Can you make profit in that situation? Yes. What is that situation? When the price falls down, you make profits. That's called as a shorting. Therefore, if you're a borrower, you have to short the interest rate future. That's the summary part I would like to tell. If you're an investor, you go long on, not FRA, long on interest rate future, IRF. Okay, I'll give an example to make you understand. For hedging purpose, IRF for hedging purpose, how it will happen, IRF for hedging. Okay, suppose you have taken a variable loan, fluctuating rate loan, fluctuating rate loan at LIBOR, let's say, at LIBOR rate. LIBOR means market keeps fluctuating. Let's say today and after 1 year, let's say. Okay, today after 1 year. So today you have borrowing, and today you have to enter into IRF. Let's say you borrow rupees 1 lakh. You borrowing rupees 1 lakh today, and lot size is rupees 10,000. So if you enter into one contract, you have to have, you will end up in exposure of 10,000. So how many number of contracts you have to enter into? I believe that you will be able to understand. IRF, number of contracts. Number of contracts will be 1 lakh is the loan amount divided by 10,000 is the lot size. So you have to sign 10 contracts. I hope that is easy for you to understand. Now, what position you are going to take is important. I told you, borrower worried about increase in the interest rates. When the interest rate increase, IRF falls. When IRF falls, you want to make profit. So what should you do to make profit in the falling prices? You do short position on IRF. In the exam, you don't have to think so much. In the exam, don't think too much. Just think borrower will short IRF. That is what you should remember. Don't think interest rate increase is the risk. Interest rate increase means IRF will fall because 100 minus interest rate, inverse relationship, IRF will fall. When IRF falls, you want to make profit. When falling prices, you have to make profit. Means you should take short position. That's a long thinking, but you think straightforward, which means what? You have to take short position on IRF for borrower. Matter over. Okay. After 1 year, suppose, okay, short position at IRF, let's say today interest rate was, let's say 8%, and after 1 year, let's say rate of interest became 9%. Now, short position, you have to sell IRF. Short position means sell IRF. If they give you bond price, you take it. If they don't give you bond price, you should do 100 minus rate of interest. Rate of interest was 8%. So 100 minus 8, 92. After 1 year, rate of interest became 9%. So how much interest that you have to pay? 1 lakh market rate, a fluctuating rate loan. So 9% into 1 year. 1 by 1 year, or 12 by 12, 1 year. So 12 by 12, which is 9,000. Okay. Now you have sold IRF. What you should do after 1 year? You have to do square off IRF. Hope remember, we have done this in forward exchange contracts. We have done these things in derivative on shares as well. You do separate transaction on shares, you do separate transaction on future market, SFM. In spot market, what do you do? In future market, what do you do? In money market, what do you do? You have done in derivatives, futures, shares, and we also done in forward contracts. I mean, foreign exchange. Okay. So you earlier you sold, now you are going to buy IRF. At what rate? The specific rate not given. So 100 minus rate of interest. So 100 minus 9, that comes to 91. 91. So what is the profit? You are buying at a lower price. So profit. Selling at 92, buying at 91. Remember, this is a percentage. This is not 1 rupee. This is 1 percentage. Difference between buy, sell, IRF, it's not rupees, it's percentage. On the lot size is 10,000 and you have entered into 10 contracts and 1 year. So 12 by 12. If it is for 3 months and all, you do 3 by 12. So 10 contracts into 10,000 into 1 by 100 into 12 by 12, you get 1,000. 1,000 rupees you receive. And 9,000 you pay interest. So what is the net amount? Net interest cost is 8,000, right? 9,000 you pay, 1,000 you receive, net interest cost is 8,000. You see, you protected your interest cost. Actually, interest rate increased, 8% became 9%. So you're paying 1,000 extra. 9,000 you are paying instead of 8,000, but 1,000 extra what you are paying is recovered. The cost extra is recovered. How? By taking position in interest rate futures. When the rate increased, you see 8% became 9%, so 92 became 91. So the price of IRF reduced. You have taken a short position. IRF reduced. You are able to make profit. Selling at higher price when falling. Buying at a lower price. That is the expectation of short position. Buying at a lower price. You make profit. Basically, you could recover your interest cost. Of course, this is a very ideal scenario. In examination question, it may not be perfect like that. See, number of contracts may not be actual number, might be rounded off. And this rate 100 minus thing what I calculated, 100 minus this, right? That may not happen theoretically. Practically, they will give you the number exactly what price you have entered at what price you executed. Like 90, it might not be 92, it might be 92.5. It might be 91, it might be 90.25, something like that. They will give you the numbers. If they don't give you the numbers, you can take 100 minus rate of interest in interest rate futures. Okay. Also, sometime one more thing will happen. This IRF will be for 6 months interest rate, 6 months contract only available, but you have taken a loan for 1 year. Then you know what you should do. This contract you should double it, because 10 contract will cover 6 months interest. I need 1 year interest. So what do you do? 20 contracts, one more 6 months interest will come. Effectively, you get 1 year coverage. So number of contracts may have to be adjusted if IRF contract and term of the loan are different. Anyway, that you see in the problems, I just told you for your reference. Okay. So this is regarding interest rate futures. It has come in the exam very rarely, not very repetitive question. What is the most repetitive question what they have asked is interest rate swaps, which we are going to learn currency swap as well. That is most important, and that we will take after the break. Okay, so moving on. Hope you're back. Next the most important I can say, and most people get confused, not comfortable, interest rate swaps. And we are also going to understand currency swaps. So what is the meaning of a swap? Swap basically means exchange. Giving something, getting something. How does it work? As usual, there will be three objectives: speculation, hedging, arbitrage. I'll take speculation first to help you understand the process. Then I'll tell you how it can be used for hedging and how to identify arbitrage opportunity. Let's understand the basics. Suppose there are two people. A, who is expecting interest rate will increase, and B, who is expecting interest rate will decrease. Think like a borrower. Think like a borrower. Present rate of interest is 8%. It may go up to 9%. A is expecting interest rate might increase. As a borrower, what will you do? Which is the suitable rate? Fixed rate or floating rate? You are expecting interest rate to increase. You don't want to increase interest rate. You want to fix the rate today itself. So if you are expecting interest rate to increase, it's recommended you have a fixed rate like a 8%. Even if market goes to 9, 10, 11, you don't worry because you have entered into fixed rate loan. If interest rate increases, you are not bothered. But Mr. B, who is expecting interest rate to decrease, for him, what kind of interest is suitable? For him, floating rate, variable rate is suitable. Why? Because if interest rate reduce, he can make use of that lower interest. Of course, we need a people with opposite intention. If people don't expect opposite, a trade cannot happen, a settlement cannot happen, any transaction cannot happen, either in stock market or in money market. So after 1 year, suppose if it happens to be 10%. Now among A and B, who became right here? Mr. A became right? Because Mr. A was expecting interest rate to increase, and it did increase. B was expecting to decrease, it did not happen. So basically, can I say A, if he had a bet, he won the bet, and B, who's taking a position, interest rate has fallen, has lost the bet. So if I tell you A and B, A has won the bet, B has lost the bet. Therefore, B has to pay to A. How much? 2% difference, I can say. Or can we also say like this? A expecting interest rate to be 8%. It is like A taking loan at 8%. A taking loan at 8% and paying 8% interest, and B taking loan at 10%, I mean market rate, which is 10% variable rate. So 2% difference. Are you getting the point? This is arrow going out. Okay. So what will happen in interest rate swap? There are two parties in the interest rate swap. One person is called as a fixed rate payer, Mr. A. Fixed rate payer. Another party is called as B, floating rate payer. One person pays fixed interest, other person pays a floating interest. And periodically, the agreement will be settled on a net basis. So if interest rate increase, like in this case, 10%, one person has to pay to another, whoever has won the bet. If interest rate decrease, another person have to make the payment over a period of time till the contract is matured, till the contract is terminated. It is also like a mutual lending contract, right? I have to pay fixed rate, you have to pay me floating rate. As good as I gave you one loan, you gave me one loan, but we are actually not giving and taking loan. We are effectively settling it on net basis. That is what is interest rate swap is all about. So interest rate swap means it's a mutual lending contracts. It's a mutual lending contract. I have to pay one rate of interest, you have to pay me one rate of interest. It is like I am giving one loan to you and you are giving one loan to me. And notional exchange of principal. Principal will not be actually exchanged, it will be notional principal. And settlement will be on net basis. I have to pay 8%, you have to pay me 10%, you pay me 2% net differential basis. What is the purpose? Three purpose, speculation, hedging, arbitrage. Speculation means taking a view. If your view goes right, you make profit. If not, loss. Hedging, you are having a risk. To reduce the risk, you use or to manage the risk, to avoid the risk management technique, that is hedging. Or arbitrage, you see there is an opportunity, the two market prices are not equal, there is a disparity, we can take advantage of it. Speculation, if interest rate rises or you are having expectation of interest rate increasing, example I gave you now, you are a you are expecting interest rate to increase, then what you should do? You should go for a fixed rate. Why? Because even if interest rate rises, you don't have to pay, so you become a fixed rate payer. Fixed rate payer will win. Like here, interest rate increases, fixed rate payer is an advantage, floating rate payer is disadvantage. If interest rate comes down, you still have to pay fixed rate, so fixed rate payer will be disadvantage. The floating rate payer, because interest coming down, he gets the benefit. Think like a borrower, interest rate comes down, floating rate can take the benefit of it, he is at the advantage, fixed rate payer is at the disadvantage. One person will pay to another. Hedging means the borrower can convert from fixed rate to floating rate or floating rate to fixed rate. Same thing for investor, depositor. I'll tell you with example little later. Arbitrage means you go for relative advantage in risk premium. Then you go for sharing the swapping gain. Then swap agreement between loan and banks. This process, you will not understand anything now. I'll have to explain numerically. Then you look at this chart again. I'm sure you'll be able to understand better. Okay, now I'll take one by one. Let's say we'll talk about speculation. One second. Okay. Just to understand how the illicit swap works, let's understand about speculation. Agreement between A Limited and B Limited. Term of the contract 2 years. Periodicity 6 months rate of interest. This is one interesting point I would like to tell you. Interest rate swap, if the contract period is 2 years, you will not settle after 2 years. You will settle periodically, maybe 3 months once, 6 months once, 12 months once, depending on the structure of the agreements. You understand? See, you enter into an agreement that like you want newspaper. You pay the newspaper subscription fees like a contract. They'll pay you every day, right? You make the settlement after 1 year, but the delivery is made every day. Like this also, the contract is 2 years, periodicity is 6 months once, so 4 settlement will come. Understand? 2 year is the validity of the contract, but within the 2 year, every 6 months once, you will make a settlement. So 4 times 6. So 4 times you will have to settle in this example. So transaction is this. A will pay fixed rate, B will pay floating rate. You can say from A point of view, it is pay fixed, receive floating. We can say like that, right? From A point of view, Mr. A point of view, what contract is this? This is going to be pay fixed, receive floating. Pay fixed, receive floating. Fine. Notional principal 10 lakh. Date of entering into contract 1/4/2020. Now you are signing on 1/4/2020. The settlement date will be after 6 months, 30th September. Second settlement after will be next 6 months, 31st March. Again next settlement, next settlement. 4 settlement will happen. I told you 6 months once. And LIBOR rates are 9, 10, 7, 9, 9.5. Every rates is given. Market rates, floating rate. LIBOR rate, you treat like a floating rate, market rate. Floating rate. Okay. Now, date. On 30th September, first settlement. Fixed rate 8%. Floating rate how much? On 30th September. Sir, 10%, sir. Not 10%, my dear friend. This will always be one term less. Remember, in bond valuation also we discussed. In a floating rate regime, you will not take the rate of interest on that date. You will always take one term less. So as on this date, I will know next settlement how much I am going to make a payment. So 10%. You should not take 10%. You should know one term less, 9%. So on 30th of September, you know on 1st of April. 31st of March settlement, you know 30th of September. 30th of September settlement, you know 31st of March. One term less, you know it. So 9%. You say, think from A point of view now. 8% fixed rate. How much is fixed rate? 8%. 8% on 10 lakh for a period of 6 months. That comes to 40,000. Variable floating rate. What is floating rate? 9%. 10 lakh into 9% into 6 by 12, which is 45,000. Okay. Now, what is the net settlement? 40 minus 45. 45 minus 40. Differential 5,000. Now, who has to pay whom here? Think from A point of view. You pay fixed, receive floating. Mr. A should pay 40,000, receive 45,000, or net settlement. You can say 1% also, net basis, either ways. That is, A will pay 40,000, receive 45,000, net settlement A will receive. And this is also quotation is called as 0 by 6. 0 today, and after 6 months settlement date. 0 cross 6. That's only for quotation expression purpose. What is the logic behind this? Mr. A is paying a fixed rate. Means he is expecting the interest rate to be same or interest rate to increase. So he went for same rate. Did it happen? Yes, interest rate increase. He made up profits. His expectation came true. But anyway, don't think too much. You simply think A is paying fixed rate, receiving floating rate. You pay more, fixed, receive floating. If receiving is more, net you receive. If pay is more, net you pay. Keep it as simple as that. Now, on 31st of March, fixed rate is 8%. Floating rate is how much? Floating rate will be on 31st of March. Floating rate will be decided on 30th of September. Means 10%. So what will be the fixed rate? Same number only, 40,000. What will be the floating rate? 10 lakh into 10% into 6 by 12, which is 50,000. Net amount 10,000. And who has to pay whom? Think from A point of view. A will receive floating, receive 50, pay 40. Net amount 10,000 is to be received. Again, interest rate increased. So, profit for you. This quotation is called as 6 by 12 after 6 months till 12 months. So, 6 by 12. Now, next is 30th September. Again, fixed rate 8%. Next rate of interest 7%. Fixed rate will be 40,000. What will be the floating rate? 10 lakh into 7% into 6 by 12, which is 35,000. What is the differential amount? Which is 5,000. Now, who has to pay whom? Think from A point of view. A has to pay fixed 40,000. Receive floating 35,000. Pay 40, receive 35. Net A has to pay, which means A will pay or B will receive 5,000. Quotation, this is after 12 months for 18 months. So 12 by 18. Last settlement date, floating rate 9%, 9 on 31st of March, 9%. Fixed rate is 40,000. Floating rate, we already calculated, I think 45,000. Same answer will come. So net amount will be 5,000. Think from A point of view. A has to pay fixed rate 40,000, receive floating rate 45,000. A will receive 5,000, and this is called as after 18 months till 24, 18 by 24. We also have a swap valuation kind of thing. But swap valuation, these are the cash flows from A point of view. A will receive plus, this is plus, this is plus, this is minus. So these cash flows you discount using the market rate of interest. That's called a swap valuation. Anyway, that we don't worry it now. The objective of this exercise is just to understand how the swap agreement works. You can take a screenshot and copy it down later, but in this one, if you have any doubt, please get clarified. This illustration is to help you understand how the swap agreement works and how the speculation works. You see, A is paying fixed, that means you're expecting interest rate to increase. So whenever interest rate increased, you made a profit. And if interest rate decreased, you made loss. Speculation, settlement in swap agreement, always on net basis. So take 2 minutes, glance through this illustration. Any amount or any column that you have doubt, get it clarified. Okay, I believe no questions on the swap settlement types. I mean, swap process, how the transactions will happen. Okay. I'll go further. So this is what happens in speculation purpose. If your expectation comes true, you make profit. If expectation does not come true, you make loss. In a swap agreement, one person will be pay fixed rate and receive floating rate. Other persons will be opposite, and it will be settled on net basis. Okay, that is for speculation purpose. Hope you have taken the screenshot of this and copy it down later. We have for hedging purpose, very important from exam point of view. For example, A Limited having an existing loan, floating rate loan, Libor plus 10 basis points of rupees 10 lakhs. 10 basis points means 10 by 100, 0.1%. And A Limited is expecting the increase in Libor rate in future. You have taken floating rate loan, and if interest rate increases, you're worried. Yes, you have to pay more. You're already having an existing situation. You're already having a floating rate loan. And you're expecting the interest rate to increase in future. So swap available is 8% for fixed Libor. Okay, so what you have to think? You have two choices in the swap. I receive fixed, pay floating, or I receive floating, pay fixed. Only two choices I have. Which one is appropriate? Take a look at this. What is the steps that we have to involve? First step, nullify the existing commitment. Remove, set off, nullify the existing outflow, existing commitment. Then whatever is your objective, the target, fulfill using swap. Sir, what do you mean by that? First, take a look at this. What is your existing commitment? Floating rate? You are paying floating rate. So if you want to nullify this cash outflow, nullify the market impact, you are paying the floating rate. So what should happen in swap? Can you think logically? I am paying floating rate. Now that number I should receive in the swap, nullify. I am already paying. I want to receive. My receipt and payment will get set off. Are you getting the point? I am having an existing outflow. I want an inflow so that this inflow and outflow can be set off. If having an existing inflow, I can create an outflow. So inflow and outflow is set off, and that's what I mean by nullify existing commitment. Existing commitment, paying a floating rate, existing commitment, paying a floating rate. So in the swap, what do I do? Nullify. So what I'm going to do? I receive a floating rate. Clear? Existing commitment, pay floating rate. In the swap, you receive floating rate, you pay floating rate. So those two are nullified, those two are set off. One floating, one floating, both are closed. And what is your objective? Is to convert into fixed rate payment. That's what happens in swap. If you receive floating, you have to pay fixed. Receive one, pay one. So you are going to do fixed rate payment. So swap transactions will be what? You receive a floating rate, that is the receive Libor, and pay fixed rate, pay 8%. So what is your position in the interest rate swap? Receive Libor and pay fixed. And how do we represent? Instead of writing this in a sentence tabular format, if it's comfortable, it's fine. I would be comfortable more representing in a chart format or a visual format like this. Take a look at this. Mr. Let's say bank and Mr. A. Okay, now Mr. A is already having an existing commitment of Libor plus 0.1. Is already having a floating rate commitment. Now he comes to bank for swapping purpose or dealer. He comes to the bank. What he has to do, look at the arrows carefully. His existing commitment is outflow, so he has to get something in the swap. So outflow and inflow both are set off. That is, you receive Libor, you receive floating rate, and you pay Libor plus 0.1. Sir, Libor receiving Libor plus 0.1 paying? That is fine. But Libor gets cancelled, right? Fluctuating rate is what is our worried. If it becomes 8%, 9%, floating rate you receive, floating rate you paid. So matter closed. And effectively you pay fixed rate. In the swap you receive something and you pay something. You receive Libor, you pay fixed, and that is the contract available. 8% for fixed Libor, receive Libor, pay 8%. And as a result, what will be your effective interest rate now? Effective interest rate, you are receiving Libor, paying Libor. So Libor gets cancelled, but 0.1 extra remains. And 8% you pay in the swap, and 0.1 you say, effectively you pay 8.1. Libor plus 0.1 you pay, Libor you receive, so I do minus receive, and 8 you pay, so I did plus 8. So whatever may happen, effectively you will pay 8.1%. In the examination, they'll ask you compute effective interest rate. You can write the visual representation like this and you can present the answer. Or if you like tabular presentation, that's also fine. Small proof verification. Let's say after 1 month or after 6 months, if Libor is 10%, what and all happening? Are you able to convert? Let us see. If Libor is 10%, what is going to be the existing cash flow? 10 lakh on that Libor plus 10 base points. 10 base point means 0.1%. So 10 lakh into Libor 10. So 10.1%, that is 1 lakh 1,000. And in the swap, what will happen? In the swap, you pay 8%, receive Libor. Libor is how much? 10%. That means you'll receive 2%, right? You receive floating rate, you pay fixed rate, receive 10%, pay 8%, so 2% gain you have, 2% on 10 lakh, 20,000. What is the net amount? 1 lakh 1,000 you are paying under existing commitment, 20,000 gain in the swap you are receiving. It is 10% minus 8%, 2% gain you're receiving, net amount 81,000, and 81,000 on 10 lakh, if you calculate 8.1%, and that is what our effective interest rate we calculated earlier. If Libor is 7%, you can verify. If Libor is 7%, so 7.1 on 10 lakh, 7.1%, 71,000. Libor is 7%, so you receive 7, pay 8, 1% loss. So 1% on 10 lakh loss is 10,000. So 71,000 you pay, 10,000 you pay, 81,000 effectively you pay. Ultimate your outflow is 8.1%. You see, if you are not entered into swap agreement, your cash flow interest would have been fluctuating. Now, because of the swap agreement, we could convert the floating rate loan into a fixed rate loan. You can also convert a fixed into floating if you think interest rate is going to fall down in the future. Anyway, so take a look at this one. See if you have any doubts in this example, because this I am going to extend further for different currencies. Different currency swap, things like that. So take a look at this. Take a screenshot. If you have any doubt, get clarified. And the most important point you have to understand concept is this. Two things. In the swap, you receive something, you pay something. How do you fix it? Whatever existing commitment, do opposite in the swap. And then opposite of that, you receive something, you pay something. Nullify the existing commitment, then whatever the position you want to achieve, you fulfill using swap. This is using swap for hedging purpose. So please take a screenshot. Any doubts, get it clarified. Okay, so I believe it's fine. For swap for hedging purpose. Okay, we have some more type of hedging, which I told you I'm going to cover currency swap as well. I'll give an example. Suppose you have present commitment in loan in GBP, present commitment, and you want to convert the loan to USD. You want to convert GBP loan into USD. You have two choices. Let's see if you're able to think which I'm going to do. Am I going to do receive USD and pay GBP, or am I going to do receive GBP and pay USD? Which one do you think is suitable here? Think in the same lines I told you, the two steps I told you, think on those two lines and see which one is appropriate here. Receive USD, pay GBP, that is appropriate, or receive GBP and pay USD, that is appropriate. So first one or second one to fulfill your objective, to convert existing commitment. Okay, sorry, I asked the question. Uh, Now we are talking about you want to take a position in swap. You are taking a position in swap. Let's talk about a company called as A. You're having an existing commitment of loan in GBP and you want to convert to a loan in USD. So what is the existing commitment? Existing commitment is outflow in GBP, arrow going out, outflow in GBP. Now you have to receive some money because you are paying something. The two steps I told you. How do you achieve hedging? First step is to whatever you are paying, receive that, means nullify the existing commitment. You are paying GBP, that is existing commitment, receive. So this is the first step, paying GBP, you already enter into commitment. Second step, you receive that, nullify the GBP outflow, and once you receive something, you pay USD. Once you receive one currency, other currency you have to pay. That is going to be receive GBP and pay USD. One more situation can happen. You can also convert into fixed income into floating income, or floating income into fixed income, equity to debt or debt to equity. How that is going to happen? For example, presently you are receiving fixed interest income from bank, FD or something, whatever. You are presently receiving from debt fixed income. You want to convert into floating income. Same process. What is the process? Whatever the existing commitment, you should do opposite. Represent. You have a bank with whom you are going to enter into swap agreement, and you are having existing commitment. What is the existing commitment? You receive. What do you receive? Your present income, receivable, present commitment, existing commitment, you receive a fixed rate income. You receive. And you receive, nullify that impact. How do you nullify receipt? You pay. So an arrow coming in, fixed interest, an arrow going out, fixed interest. Think from a point of view. Nullify existing commitment, receive fixed rate, make it as pay fixed rates. And you receive opposite, that is floating rate or whatever is equity income. So you have converted from fixed income into floating income. So the swap will be receive floating, pay fixed. You can see floating coming in, fixed going out, receive floating, pay fixed. Or you can even convert Nifty index portfolio, you can convert it into fixed income, equity into debt, objective, you are investing in equity now, but market is fluctuating, too much risk is happening, corona third virus, fourth virus is coming, mpc committee, that is RBI committee, monetary policy committee, even at the fed level, us bank. So a lot of risk is there. I don't want to be in equity, I want to convert into debt, but I want to sell the portfolio, I want to convert to debt for a short term only. So what do? You enter into swap. So my present income is investment in index, Nifty index portfolio, equity portfolio. I want to make it into fixed rate income for short term period. You enter into swap. What swap? Same two people. Your existing commitment, you are receiving Nifty returns, Nifty index, existing returns you are receiving, and you nullify this impact. Nullify this impact means you are going to pay this, right? So whatever coming in, you pay it. That will be nullified. So receive Nifty and pay Nifty, receive Nifty and pay Nifty. That is get offset. And if you pay Nifty, what comes in fixed rate? So it's going to be receive fixed rate, pay Nifty returns. That will convert your existing commitment of Nifty returns into fixed rate interest. So when you want to stop the risk for a time being, you can convert floating into fixed using the swap hedging purpose. Okay, so this is about different types of hedging. We even have a credit default swap and all, but will not go into that extent. But just try to understand how the swap mechanism works, especially in hedging situation. Okay, I'll go further. Okay, next we have in the interest rate swap, how do we make use of arbitrage? Arbitrage in interest rate swaps. What is the arbitrage? Two situations, there is a opportunity. Disparity in the prices, disparity in the interest rates. How are we going to achieve it? Take a look at this. Let's say bank is there and the bank is giving loan to your friend at 16%. But the same bank is giving you the loan only at 14%. How come the bank is giving loan at a cheaper rate to you? Is bank manager your father-in-law? No, maybe you're having a better credit risk than other your friend. So what arbitrage you can make use of? You take loan from bank at 14%, you give it to your friend at 15%. So you can make money, he also can save interest. That is arbitrage process. Of course, as a friend, you know him, whether he'll make the payment or not. Risk of return is always there. But you take that risk, there is an arbitrage opportunity. It's a simple mechanism process. But in case of uh, swapping, how it works. Just give me 1 minute. I'll explain how it works in a interest rate swap, the hedging mechanism. These kind of questions you can expect in exam as well. Just give me 1 second. Okay. How the hedging works? Let's say I'll explain this. How the swapping arbitrage opportunity works. Take a look at this. A bank is quoting the following interest rate structure: X limited and for Y limited. You observe for Y limited, if you take a floating rate, they're charging you more. If you take a fixed rate, they're charging you more. Why is that? How come for Y limited, floating rate is also is charged more and fixed rate also charged more? Maybe because Y limited have a poor credit rating, double, triple B, double B, single B, C, D. Credit rating and all would be there. So company having a poor credit rating has got a higher interest rate because bank is taking risk and they want higher return for that. That extra return is called as a premium. So in floating rate, they're charging 0.2% extra. In fixed rate, they're charging 2% extra risk premium. This is where the arbitrage comes into play. For fixed rate loan, they charge 2% interest extra. For floating rate loan, they charge 0.2% extra. It is not equal. There exists arbitrage opportunity. They are not charging same risk premium. There exists arbitrage opportunity. So we have absolute advantage and relative advantage concept. What is absolute advantage concept? X limited can take the floating rate loan cheaper and fixed rate loan also cheaper. That's what we say absolute advantage. Then we have relative advantage for Y limited. Now between floating rate and fixed rate, where it is cheaper to them. Sir, Y limited, in floating rate also they are paying more. In fixed rate also they are paying more. Correct? But between that one, where they are paying relatively less, they are paying more. But among the more, which is little less. Floating rate, because they pay only 0.2% extra, less costly. This is like telling absolute advantage and relative advantage. Absolute advantage means I don't have, I'm unhappy. Relative, absolute poverty, that is. Relative poverty means my neighbor has it, I don't have it. Relative poverty. You can also apply in your life. That is, you failed. You feel bad. That is relative disadvantage. You also failed. Your friend also failed, but you got 31. Your friend has got 30. You're a little bit happy. You got one extra. So, both are costly, but between the costly, relatively cheaper one is Y limited, and that's what we say Y limited is having a relative advantage. And how much advantage? 2% extra here, 0.2% extra here, that is 1.8. That is what is called as swapping gain. The arbitrage advantage, 2% minus 0.2, that is what is called a swapping gain. And swapping gain will have to be shared among both the people because you cannot achieve this on your own. You need other people's support to achieve this. So a dealer also will come into play because some person should connect this X and Y limited. They will not know each other. Dealer also will get his share, let's say 40 basis points, which means 0.4%. Now remaining share will be equal for A and B, let's say. So 1.8 is the total gain, 0.4 you subtract, that is 1.4 you get, 1.4 divided by 2, 0.7, 0.7. So dealer will get 0.4%, A will get 0.7% and B will get 0.7%. And mind it, this 0.7, 0.7, they don't get as a profit, they get it as a saving in interest. We are going to prove how. Take a look at this. First, you start with company with relative advantage should take loan from bank. Which company having relative advantage? Y company having relative advantage. So first, they should go to the bank and take loan at LIBOR plus 0.2 where you have relative advantage. Then another company will take opposite rate loan from the bank. So X Limited will take opposite loan. What is opposite loan? Fixed rate from the bank. And then what they do, they swap it among themselves through interest rate swap. Which means what? What is happening? Take a look at this. It will happen like this. X will take fixed rate loan from bank. Uh, okay, first Y should take. Okay, 1 second. Okay. Now, company with relative advantage. Who is having relative advantage? Y. That's the starting point. So, Y should take floating rate, that is LIBOR plus 0.2 floating rate. Let's say floating rate. Y go for floating rate and X should go for fixed rate. And in the swap, they need to exchange themselves. So, Y will go for receive floating, pay fixed. X will receive fixed, pay floating. Don't worry, I'll explain. The transaction should be such a way that all the parties get their share of gain in terms of their interest savings, that is interest with these transactions compared with interest without this transaction. I'll explain this with the numericals, don't worry. Now, I'll explain the help of a representation. We have two people, X limiteds and we have Y limiteds. And in between them, we have dealer. Okay. Now, what is the first step I told you? A should go to bank, right? X should go to bank. Y. So Y should go to bank. Y should go to bank and take floating rate. So Y goes to bank, X goes to bank, and they will swap among themselves. Understand this process once more. Fixed rate, floating rate, will come to it later. First, understand the parties involved. X is one party, Y is another party, dealer is one party. Y goes to bank, X goes to the bank, and both of them come to dealer. So Y having a transaction with the bank and Y having a swap with dealer. X having a transaction with the bank, X having a swap with dealer. This is a structure. Okay. Now take a look at this. Y is going to the bank and taking what rate? Floating rate. Let me type the types first. Then we'll come to the numbers. Y is going for floating rate. If Y is go for floating rate, what should X do? X should do fixed rate. Starting point, Y. Going for floating rate. Why? Because of relative advantage. Whatever Y is doing, X is doing opposite. Clear? Whatever Y is doing, X is doing opposite. Now look at the arrows. What should Y do? Is the existing commitment is pay floating. Existing commitment is pay floating. If you are paying floating, what should you receive? Nullify existing commitment. So you should receive a floating rate. Correct? Receive floating rate and pay fixed rate. Receive floating means pay fixed. What will happen to X? Observe, he is paying fixed rate. If he is paying fixed rate, what should he receive? Paying fixed rate means the arrow coming in, he should receive fixed rate and pay floating rate. Hope you're able to understand. Whatever Y does, opposite X does. And whatever your existing commitment, and reverse that commitment in the swap. Okay, now what Y is paying? Y is paying LIBOR plus 0.2. So LIBOR plus 0.2. Y is paying LIBOR plus 0.2. So what should Y receive then? LIBOR plus 0.2 he will receive. Understand? LIBOR plus 0.2. You pay LIBOR plus 0.2, receive LIBOR plus 0.2, that is closed. And what is that? Y should pay fixed rate. What is Y's fixed rate is? Y fixed rate is 12%. And if you pay 12%, with this transaction, without this transaction, it will be 12% only. What is the advantage of going with this 12%? So you need to give some benefit. What is the benefit for Y? I mean, I think it's actually X and Y, not A and B. X and Y. Anyway, it does not matter. So what should the benefit X should receive? 0.7. So without this loan, you have to pay 12% minus the gain 0.7. So you have to pay 11.3. That's what I'm trying to tell you in this transaction. The transaction should be structured in such a way that all the parties get their share of gain in terms of the saving with these transactions compared with the interest without this transaction. That is, you would have got 12% without this fixed rate. Now you should get gain of 0.7. So with this loan, you should get 11.3. Thereby, zero point 0.7 can be gained. Same process I'll do for X also. X what is going to do? X has to pay fixed rate. What is X fixed rate? 10%. X will pay 10%. You are paying 10%, receiving 10%. So pay 10%, receiving 10%. That is set off. And what is that? You should get the benefit now. You are paying floating rate. What is the floating rate you are paying? Libor. And what is the benefit you should get? 0.7. So what should be your net cost should be now? Libor minus 0.7. Libor is existing, saving is 0.7. And dealer, you can verify his position. What is the position of dealer? What and all is receiving? What and all is paying? What and all is receiving? What and all is paying? He is receiving arrow coming into him. He is receiving 11.3 and is receiving Libor plus Libor minus 0.7. So effectively is receiving Libor and 10.6. And what about he's paying arrow going out? He's paying 10% and is paying Libor plus 0.2. Libor plus 0.2. So Libor plus 10 plus 0.2, that is 10.2. And if you compute the net amount, LL gets cancelled, 10.6 minus 0.2, that is 0.4. That was the objective, right? Dealer, 0.4. Yes, balancing figure will always come like this, 0.4. Three parties are there. Two parties you calculate. Balancing figure, you will get the dealer's position. Or if two parties only there, you create Y position, X will be balancing figure. Or you create X position, Y will be balancing figure if dealer is not there. If dealer is there, you fix the X position, you fix the Y position, balancing figure will be the dealer. This is fixed rate floating rate loan. Same logic applies for USD loan, GBP loan. The balancing figure, the dealer will take the hit, will take the exchange rate fluctuation risk. Anyway, understand the process. Take a screenshot of this. Summary of this, I'll give in a chart format so that for solving problems, that should be used as a simple reference point. Anyway, I'll give you the chart. First, you take a screenshot of this. Okay, hope you have taken this screenshot. I'll go to the summary chart on this. So, what are the steps that are involved in constructing the arbitrage in the swap? First step, you compute swapping gain. What is swapping gain? Difference between difference. Difference between fixed rate, difference between floating rate, risk premium in the fixed, risk premium in the floating, and difference between those two, that is your swapping gain. And that should be shared among the parties, shared among the dealer, and remaining balance equally may be among the parties involved. And identify person with relative advantage. And who is the one relative advantage? Entity which is paying higher interest. Among the higher interest, choose the lower one. So company Y, who is having lower credit rating, is paying higher interest. And within the two type of loan, choose whichever is less costly, cheaper interest risk premium. That is the starting point. Start with entity with relative advantage with the bank. Why going to the bank? Taking floating rate loan. Other entity, opposite type of bank, company X goes to the bank and take fixed rate loan. Floating rate loan for Y? Because they have relative advantage. X will have opposite one, which is fixed. Then swapping among the entities with opposite transactions and use structure such a way that the interest will be saved in the form of gain. So then the structure will be such a way that the structure, you have to structure rate of interest such a way that your interest savings, your swapping gain, your swapping gain share Your swapping gain share should be equal to interest savings. Interest savings. Okay, this is what the example I gave you and the summary chart for a quick recap. You can take a screenshot of this and copy it down later. Okay, I hope it is done. I'll go further. So this is the discussion on interest rate swap for speculation purpose, for hedging purpose, and more importantly, arbitrage purpose. This has been asked quite a few times in exam. Now let's go for one last variety in interest rate management chapter, that is interest rate options. I hope you remember that instrument option, call option, put option, lot size, strike price, premium, underlying asset, expiry date. Because if you don't understand that, this you can forget about it. Interest rate options, derivative where underlying asset is rate of interest. Regular features will be their premium at the beginning, strike price on expiry, holder, writer. Holder will pay premium, writer will receive premium. And on the expiry, if it is beneficial, holder will exercise. Intrinsic value, market price minus strike price for call option, strike price minus market price for put option, call option exercised if the market price is high, put option is exercised if the market price is low. I hope you are aware of all those features. Then you always come to this chapter, interest rate options. Now, this is the special feature of interest rate option. Premium is at the beginning of reset periods. What is reset period? The contract may be valid for 2 years, but settlement can happen 6 months once. So if I tell you 2-year contract, it does not mean it is settled only once. Interest rate might be settled 6 months once. So 4 times, if 4 times settlement happens, 4 times premium should be paid. And sometimes you might have to pay only one time. For all those 4, you might have to pay one time. In that case, what do? You divide by 4. No, you don't divide by 4, you divide by annuity factor, equivalent present value terms. Anyway, that you see in the problems separately. Strike rate, the strike price we call for shares. Here we say strike rate. Option lying with the holder, and writer should oblige. Same feature will continue. Lot size will be there. Those kind of things. And we have 2 types of option, in say 3 types I can say. Interest rate cap, nothing but call option on interest rate, exercised when the market price is high, market rate is high, reference rate is high, LIBOR is high. When the market rate is high, call option, interest rate cap is exercised. Right to buy or right to borrow. You can say right to buy or right to borrow. It is same as right to borrow. Interest rate floors. Floors is like a put option on underlying asset. Right to sell, or you can say it is right to deposit, right to invest. right to deposit or right to invest. Then we have collar strategy, interest rate collar. It's like a strategy where you buy cap, buy call option and sell put option. You are a holder in call option, writer in put option. It's called as interest rate collar. And for hedging purpose, what and all can be used if you're a borrower, right to borrow, interest rate cap is suitable. If you're an investor, interest rate, floor is suitable. You can also make use of collar if the problem says it. Anyway, this is the overall summary of it. Now I'll give an example, numerical example for interest rate caps, how it function, how it can be used for hedging purpose. Then we'll look at interest rate floor, then we'll look at interest rate collar for hedging purpose. This is just a beginning, just a recap. Strike price, premium, intrinsic value, payoff, payoff chart, holder, writer. Hope you remember all those your previous life. Okay. How does interest rate cap option works? Cap, like a top, cap. Why is it called? I'll show it to you. This is right to buy. Just like right to buy, here it's called as right to borrow. I'll show you how it happens. Take a look at this example, then you can take the screenshot. Strike rate 10%. Market rate, let's say 6 months LIBOR rate, reference rate. So 6 months and contract period 2 years. So how many times it will happen? 6 months, 6 months, 6 months, 6 months. 4 times it will happen. That's called reset periods. Lot size, notional principal 1 lakh. Premium 0.1%. How many times you have to pay premium? 4 times you have to pay. Now reset period 1, 2, 3, 4. That is 6 months, 12 months, 18 months, 24 months. 6 months, 12 months, 18 months, 24 months. 4 times. Then LIBOR. That is market rate. LIBOR is like market rate. 8, 9, 11, 12. Let's say this is given in the problem. These are the situations we are discussing. These are the situations. If it happens like this. Strike rate. Means strike price. What is strike price? 10%. 10, 10, 10, 10. What will happen? Will the option be exercised? What is the basics of call option? Call option is exercised when the market rate is more than strike price. Market rate is 8%, strike rate 10%. No, you don't exercise laps. 9 and 10, don't exercise laps. 11 and 10, yes, market rate is more exercised. Market rate is more exercised. This is in terms of options, call option. What is the logical aspect? If you think from interest rate cap option, what is the interest rate option? Rights to borrow. Think from holder point of view, rights to borrow. So, if you go to option, you can borrow at 10%. You go to the market, you borrow at 8%. Where will you borrow? You borrow at a lower rate. So, you go to market and borrow it. It's cheaper to borrow in market. Option is not beneficial. Option will lapse. Second situation, 9% in the market, cheaper in the market, option not useful. Now when market is 11, market is costly, you don't go to market and borrow, you borrow at strike rate, that is you borrow in options, option is exercised. Same thing in the last situation. And what is the benefit you get? Intrinsic value. Option elapses, first and second situation, 0, 0, IV, intrinsic value. And in third situation and in fourth situation, 1%, right? 11 minus 10, 1%, 12 minus 10, 2% is intrinsic value. Premium, you would have already paid 0.1%, so effective rate of interest. Of course, I should adjust premium also, but anyway. So 8% minus 0. Intrinsic value is the benefit you receive. Rate of interest, your existing commitment. So 8% is your outflow. And 9% minus 0%, 9% outflow. 11% you pay. Existing loan, existing reference rate, you have an existing loan at 11% and you receive 1%, effectively you get 10% loan. You pay 12%, receive 2%, existing loan 12% commitment, 2% intrinsic value, you get in the options 10%. You see, effectively it is only 10%, right? You are not going beyond 10% under any given situation, maximum is 10%. Your rate of interest capping maximum outflow capped, maximized at 10%. That is why it is called as the interest rate cap option. Okay, this is make you understand the concept. Solving problem, what format we know? You know, our options format. I'll show you that. Reset period 1, 2, 3, 4. Libor 8, 9, 11, 12. Intrinsic value. How do we calculate intrinsic value? Market price minus strike price. 11% minus 10%. Market price minus strike price. But this is a interest rate management chapter. The percentage should be converted into rupees. To convert into rupees, I need two things. What do I need? I need to apply by loan amount and apply by the term. Loan amount, lot size. If your number of contracts is there, you multiply. And the term 6 months Libor, so 6 by 12. Now 12% interest means the 2% is the intrinsic value on that 1 lakh notional principal into term 6 months. These are the intrinsic value which you receive from call option. Premium 0.1%, 0.1% of 1 lakh. 100 rupee premium is what you pay. What is the payoff for the holder? Intrinsic value minus premium is a payoff 0 minus 100 equals minus 100, 0 minus 100, 500 minus 100, 1000 minus 100, 900. The same format what we discussed in option chapter. Okay. Now what will be your interest expense? Interest expense will be the reset 8% on 1 lakh for 6 months. So 8% on 1 lakh for 6 months. 1 lakh into 8% into 6 by 12. You get 4,000 like that. You get 4,500 like that. You get 5,500. You like that. You get 6,000. So you multiply it by these rates on 1 lakh into 6 by 12. And what is your effective interest expense? 4,000 interest expense you pay. Payoff also you pay. So don't do 4,000 minus 100. It is 4,000 expense. 100 is also expense. So 4,100. Or mathematically you can say this column minus this. 4,000 minus of minus 100. So you get 4,100. Then 4,500 is also outflow. 100 is also outflow. 4,600, 5,500 minus 400, 4,000, 5,100, 6,000 minus 900, 5,100. So you can see 5,100 is your maximum outflow. Anyway, so this is what is the calculation is going to happen in interest rate options. Take a screenshot of this. Then I'll go for interest rate cap option, how it works. This is interest rate cap. I'll have to explain interest rate floor. Anyway, first you take a screenshot of this. Okay, now let me explain interest rate floor. Yeah, effective interest rate. Effective interest rate also you can calculate. How do you calculate? 4,100 by 1 lakh into 100, and this is for 6 months. How much for 12 months? That's how you get 8.2. And you can see the maximum came to 10.2%. That is because you are paying a strike rate at 10%, a premium 0.1, because 6 months once premium. So 10.2, 10 plus 0.1, that's what is 10.2. Actually, interest rate cap. Your interest outflow cannot go beyond this. That's why it is called as interest rate cap. Your interest expense is capped, maximized at this interest rate. Only for this first one calculation I showed it to you. Others you can calculate. Okay, I'll go further. Okay, interest rate floors, nothing but put option, applicable for investor deposit holders. Let's say strike rate 5%, market rate 6 months Libor, reference rate, contract term 2 years, reset period 4, lot size 1 lakh, premium 0.1%. Same situation I'm discussing. Reset period 1, 2, 3, 4, Libor 4, 4.5, 6.6, 6.5 situations I'm telling. Strike rate given 5555. Put option is exercised when the market rate is less. So market rate is 4, 4.5, below 5, exercised. 6, 6.5, above 5%, not exercised. What is the logic in interest rate management chapter? This is right to invest. So will you invest at 5% or will you invest at 4%? Obviously you invest at 5%. So it's beneficial to invest at the option, beneficial to invest at the option, whereas here you get 6%, 6.5, beneficial to deposit in the market rate. So option will lapse, invest in the market rate at a higher rate. What is intrinsic value? When the option is exercised, difference. So 5% minus 4%, 1%. Similarly, 5 minus 4.5, 0.5. And last two situation, option will lapse. Rate of interest, you're receiving how much? And in the market, same as Libor rate, 4, 4.5, 6, 6.5. And effective rate, you receive 4%, you receive 1%. So 5%. You receive 4.5, receive 0.55, 6, 6.5. You can see your minimum rate of interest is 5. Whatever happens, that is what is strike rate. That is why it's called as floor. From an investor point of view, this minimum return is guaranteed. That's what this option is doing. If I express it in rupee terms, what will happen? Reset period 1, 2, 3, 4. Libor rate 4, 4.5, 6, 6.5. How do you calculate intrinsic value in rupee terms? For first one, I'll show the calculation 5% and strike rate 5, strike rate 5, market rate 4. 1% is the benefit you're getting on a notional principal of 1 lakh. For a period of 6 months, 500 you receive. Same thing for next situations. Premium 0.1% of 1 lakh. So 100 you pay, 100 you pay, 100 you pay. That's a flat amount you have to pay. What will be the payoff? Intrinsic value minus payoff for the holder. 500 you receive, 100 you pay, 400, 250 minus 100, 150, 100 minus 100 minus 100. And interest income you receive at the rate of 4%, for market rate 4% on 1 lakh for 6 months. So 1 lakh into 4% for 6 months, you get 2000, like that. Others at 4.5, at 6, 6.5. So what will be your effective interest income? 2000 you receive, 400 also you receive. So 2400. 2250 you receive, 150 also you receive, 2400, and so on. And what is the effective rate of interest? 2400 you receive on 1 lakh into 100 in percentage. This is for 12 months. How much for 6 months? Sorry, this is for 12 months. This for 6 months. How much for 12 months? That is what this comes to 4.8%. Similarly, you can calculate for others. You get it. Minimum is 4.8%. What is at minimum 4.8%? Your strike rate is 5% and premium you have to pay 1.1, 2 times a year per annum basis, means 0.2 it will come. 5 minus 0.2, your effective interest is 4.8. Anyway, so this is how interest rate floor options will work, that is put option, right to invest. Take a screenshot of this. I'll explain one last one, which is interest rate caps we did, interest rate floor we did, interest rate collar we have. Between floor and cap, a collar. So we have interest rate collar. Anyway, I'll explain that. In even shares also it was there. Derivative, collar strategy. We did not discuss that there. Anyway, take a screenshot of this. Okay. Now, interest rates collar strategy. Okay. What is the interest rate collar strategy? Combination of two positions. You are a holder of cap and writer of floor. That is, call option you become holder, put option you become writer. Let me give those details. Strike rate 10%, market rate 6 months LIBOR rate, contract term 2 years, reset period so 4, 6666, lot size 1 lakh, premium 0.1%. Same data only I am taking. What about put option? That is floor option, strike rate 5, 6 months LIBOR, reference rate, contract term 2 years, reset period 4 years, lot size 1 lakh, premium 0.1%. Same thing I have taken. Okay. What is the reason behind this? You become holder of call option, you pay premium, and writer of put option, you receive premium. So your return, your cost of hedging will come down. Holder, pay premium. Writer, receive premium. So your cost of payment will come down. That is the reason behind this. I'll show you how. So reset period 1, 2, 3, 4. LIBOR rate, market rate 12,864. Strike rate, cap. That is 10%, 10, 10, 10, 10. Now, will the call option be exercised? You are a holder. You are a holder. So 12% minus 10%, when the market rate is high, call option exercised. So 12 minus 10, that is 2% is your benefit. Premium, I'll take it later. For the time being, ignore premium. And second situation, market rate is less, not exercised, not exercised, not exercised. What about your floor option? Strike rate is 5. Be careful. Floor option, put option. You are not a holder. You are a writer. So your intrinsic value will not be positive. Your intrinsic value will be negative. You are a writer. And when will the put option be exercised? When will the fourth option be exercised? When the market rate is less. So 12, 8, 6. All these three situations, it is more than 5%, option lapse. In last situation, 4%, market rate is less. Yes, option is exercised by the holder, and you being the writer will have to take the hit of negative intrinsic value -1. For the time being, ignore premium. And you are a borrower, you borrow at market rate. What are market rate? 12,864. What is your effective borrowing rate? Look at this one, this borrowing rate plus this intrinsic value plus intrinsic value. If you receive, subtract, you pay. If you receive, subtract, you pay, you add. 12% you pay, borrower. 2% you receive, net amount 10%. 8% you pay, 0, 0, 8 only. 6%, 0, 0, 6% only. 4% you pay, and 1% you pay, -1. So 5, minus of -1 comes to 5%. And did you understand? Your borrowing rate is always between 5 to 10%. That's what the strike rate, between 5 to 10%. Of course, this should be further adjusted for premium, which I'm not considering for the time being. So your borrower interest rate, between the two interest rate, it will not go beyond this rate, it will not go below this rate. Your interest is always in between. There's a strategy you created called as collar strategy. But anyway, conceptually, you are a holder of call option and writer of put option. Objective is to recover the premium to reduce cost of hedging. Anyway, take down this example. Again, from exam point of view, I don't really expect an exam much, but rarely asked. 1 out of 20 exams or something they asked. So I've explained the format and the concept. So take a screenshot. Copy later. So this is the complete summary, complete overview of interest rate management, starting with forward rate agreement. Then we went to interest rate futures. Then most important, interest rate swaps. Along with that, we understood what is a currency swap as well. Then we have interest rate option, cap strategy, flow strategy, and collar strategy. We also have some theory question like swaptions. Like interest rate swap, it's a commitment, profit or loss. But if you have an option on that, option on swap, you have to pay premium. Anyway, those problems and all will not even think about it. That can come for theory question only. Anyway, so broadly we have 4: interest rate forward rate agreement, interest rate future, interest rate options, and then we have interest rate swaps. Okay, so this completes the summary part of interest rate management. Exam problem also. Hope you got it. Parker and Co. is contemplating to borrow an amount of rupees 60 crores for a period of 3 months in the coming 6 months time from now. The current rate of interest is 9% per annum, but it may go up in 6 months time. The company wants to hedge itself against the likely increase in the interest rates. The company's banker quoted forward rate agreement at 9.3%. What will be the effect of forward rate agreement and actual rate of interest cost to the company if actual rate of interest after 6 months happens to be 9.6%, 8.8%. Typical situation you will come across in examination conditions. The problem is regarding borrowing. Borrower is contemplating to borrow. He has not borrowed it yet. He is contemplating, means he is a projected or expected to borrow, future borrower. And what is the requirement? The company wants to hedge itself. Okay, they want to hedge the interest rate. Means when you borrow later, the rate of interest might increase or might decrease. That is the uncertainty you're trying to face. To avoid that uncertainty, to face that risk, the bank is going for, the company is going for a forward rate agreement at the rate of 9.3%. Of course, here straight away they have given the forward agreement 9.3%. In some other problem, they might give you two quotations, 3 months, 6 months, 3 by 6, 6 by 9, like that. And one borrowing rate, deposit rate, low rate means deposit rate, higher rate means the borrowing rate. So you have to choose the higher rate. But the quotation here may not be relevant, but we should understand what is the quotation of forward rate agreement is all about. A cross B, where A represents the date of borrowing, B represents the date of repayment. So B minus A, the difference between these two only will talk about the term of the loan. So in this situation, can you think what would be the forward rate quotation if you just have to express it for a period of 3 months in the coming 6 months from now? So when are you going to borrow? You are going to borrow after 6 months. So A, date of borrowing will be 6 months today. And for when are you going to repay, or what is the term of the loan? Term of the loan is 3 months. Therefore 6 plus 3, that is 9 months from today, you are going to make a repayment. So effectively you can see B minus A, 9 minus 6, that's what is 3 months, the term of the loan. So in this problem, the quotation, if you have to express, it will be 6 by 9. 6 into 9. And forwarded agreement can be settled on net basis, or forwarded agreement can be settled on uh, delivery basis. But they are asking what is the requirement here. The company's banker quoted a FRA at 9.3%. And what will be the effect of FRA? Effective FRA means we have to calculate only towards FRA. Had you taken FRA agreement, what would have happened? Had you not taken forward agreement, what would have happened? Without. Ultimately, net. Understand? Effective FRA. Had you taken the forwarded agreement, had you not taken the forward agreement. So basically, you have to tell the net amount, net effect means you have to give explanation. You have to solve this problem on settlement on net basis. Even otherwise, usually in examination condition, please solve it on net basis. And they are giving two situations. After 6 months, it turned out to be 9.6%. After 6 months, turned out to be 8.8%. Two situations we have to answer. Not a problem. We'll do it. Okay. So what and all we are going to write? We will write transaction today. use some space for particulars. Transaction today and transaction after 6 months and transaction after 9th month, that is 3 months from that time. And they're giving two situations. Actual interest rate turns out to be 9.6, 8.8. Actual interest rate, let's say reference rates, market rate, reference rates happens to be 9.6% or reference rate happens to be 8.8%. And corresponding situation for that. If reference rate was 9.6, if reference rate happens to be 8.8, corresponding impact after 6 months, the corresponding impact, what will happen after 6 months, I mean after the at the time of repayment. Okay, now in forward rate agreement, what transactions you do today, you will enter into buy forward rate agreement at the rate of rate is given 9.3%. Forward agreement quoted by bank 9.3%. Why are you going to buy forwarded agreement? Because you're expecting interest rate to go up. If something goes up, if interest rate goes up, that means you're expecting the price to go up. When you're expecting something going up, you're expecting something going up means you're having a bullish position, right? So expecting the rate of interest to go up. When something is going up, you should buy it. You're expecting to go up, you should buy it. That's why it is buy forward rate agreement. And after 6 months, you're going to sell the forward rate agreement at whatever reference rates, at reference rate. So what will be the settlement amount you get? Now you can write the formula also if you want. The amount received under FRA net amount, FRA net amount will be calculated by you sell at reference rate minus buy at forward rate multiplied by the whatever the loan amount or notional principal, I'll say NP, notional principal, into T divided by 365, that is for number of days. And this will be the amount to be settled after 9 months, actually at the time of repayment. So I bring back from 9 months to 6th month. So I have to bring back to today. So this will be 1 plus whatever the reference rate, market rate, that you multiplied by T by 365. This is a formula you can write down. Institute give different notation. They don't write T, they write D. I mean number of days after all. NP represents notional principal. R minus FR, Institute also uses the same thing. Okay. Now in this case, if it is 9.6%, then what will happen? 9.6% is the reference rate minus the forward rate 9.3% divided by whatever notional proceeds, in this case into notional proceeds amount of loan 60 crores. So multiplied by 60 crores and how many days? 3 months. This is 3 months. I've taken number of months. Number of 365 is also fine. You can do number of days basis or you can do number of months basis. I'll do number of months basis. That is 3 by 12 whole divided by 1 plus reference rate 0.096, 9.6% multiplied by again 3 by 12. Okay, I'll explain once more the logic behind this formula. You're buying at 9.3, selling at 9.6, so you make a profit of 0.3%. Easy explanation. Other way of explanation, what they're asking, effect of FRA. That is, what is the impact of a forwarded agreement? Had you taken forwarded agreement, by taking forwarded agreement, what is your commitment rate? At what rate you have the right to borrow? You have the obligation to borrow. At what rate? Forwarded agreement, that is 9.3%. Now, had you not taken forward rate agreement, you would have taken the loan in the market and the market rate would have been 9.6. So you would have taken the loan of 9.6%. But by entering into forward rate agreement, you entered only at 9.3. So by entering into forward rate agreement, did you save or did you lose? Had you not entered into forward rate agreement, you would have had to pay more, right? 9.6 you had to pay. Now, by entering into forward rate agreement, you have to pay only 9.3, which means you save 0.3%. That is why it is going to be positive amount, or whatever you calculate, you are going to receive equals to, that's what you are going to receive. Just rewrite it here so that I can find space for other situation also. So RR 9.6 minus FR forward rate 9.3 into notional principal 60 crores multiplied by T 3 by 12 whole divided by 1 plus 9.6% reference rate 0.096 for 3 months. Why 3 months? Because we are doing the present value from 9th month to 6th month. Because numerator represents the amount of settlement at the time of repayment on maturity. Maturity is after 6 months. But settlement will happen after 6 months only on the fixing date. So you bring down present value for 3 months. Okay, so if I calculate it, denominator will be 0.096 into 3 by 12 plus 1. Okay, 1.024. Okay, 0.096 minus 0.093 into 60 crores into 3 by 12 divided by 1.024. 4,39,453. 4,39,453. So this is the effect of FRA. By entering into forward rate agreement, you could save 4,39,453. Did you get the point? By entering into forward rate agreement, we could save 4,59,453. Otherwise, I had to go for market, I had to take the loan at a higher rate of interest and I had to pay more. Now, to this extent, my interest cost has been reduced. That is the effect of FRA. And actual rate of interest cost. Actual rate of interest cost, okay, that is in money market. In money market, you borrow. Today you do nothing because you are not a current borrower, you are a prospective borrower. So today you do nothing. After 6 months, you are going to borrow 60 crores. And after 9 months, you are going to repay borrowing. And that means what will be your interest cost? Your interest cost will be 60 crores into, in this situation, if I calculate, in this situation where market rate happens to be 9.6%, settlement on net basis, you should go to market and buy, take borrowing. So borrow 60 crores at 9.6%. So 9.6% for a period of 3 months. So 60 crores into 9.6% for 3 months, 1 crore 44 lakh. 1 crore 44 lakh. So what will be the net interest cost? Net cost. Here 1 crore 44 lakh, you are going to pay amount And 4,39,453, you could save interest by entering into forward rate agreement. So what will be the net cost? So this 1.44 crores is what we pay, and 439,453 is what we receive. But there is one small challenge here. What is that? They are not happening at same point in time. 1.44 crores is taking place after 9 months, whereas 439,453 is taking place after 6 months. So if you want to adjust, you have to apply time value of money, which means this 6 months, once you receive, you don't keep it with yourself. What you are going to do, you will deposit for 9 months. So this will mature after 9 months. At how much? You are going to write 4 lakh 39 453. This will give you interest. You will deposit an interest for 3 months. So multiplied by 1 plus 0.096 into 3 by 12. So how much this will become? So 439 453 into 1.024, 4,50,000, I think. 4,50,000. So that the 4,39,000 at the end of 6th month, you deposit for 3 months, it will become 4,50,000 at the end of 9th month, so that both cash flows are comparable now. So 1 crore 44 lakh, that amount you are going to make the payments. 4,50,000 you are going to receive the amount. What will be the net cost? So if you calculate the net cost, 1 crore 44 lakh minus 4,50,000, 1 crore 39 lakh 50,000. Net cost 1 crore 39 lakh 50,000. This is the net cost if the situation happens to be 9.6%. So take a look at this one for 2 minutes. See if you understood these calculations clearly, because what we are going to do now, next one more situation, if it happened to be 8.8%, how these numbers will change. So please take a look at this calculation, write it down. For any doubts, get it clarified. Okay, I hope you got it till here. Now let's go for second situation. if interest rate turned out to be 8.8%. In this case, what do you do? RR minus FR. RR is 8.8% minus FR, that is forward rate, 9.3% on 60 crores for a period of 3 months, divided by 1 plus forward rate, market rate, our reference rate, or our reference rate means market rate, 0.088 into 3 by 12. So when you do 8.8 minus 9.3, you get minus number, which means you have to pay this much of amount. 0.088 into 3 by 12, 1.02. So 8.8% minus 9.3% into 60 crores into 3 by 12 divided by 1.022. So 7,33,855, I think. 7,33,855. What is the other way of understanding this point? Had you not entered into forward rate agreement, you would have borrowed in the market at 8.8%. Now, because of the forward rate agreement, you will be paying 9.3%, which means on a net basis, you end up paying more now. It would have been better had you not entered into forward rate agreement. So, you are paying more under forward rate agreement. That is a loss for you. Anyway, or you are expecting rate of interest to go up. So, you buy forward rate agreement. The rate of interest came down. It is against your expectation. Therefore, you are having a loss. Hope you are able to understand. Now, after 9 months, what will happen? You will pay, you will borrow the money. You borrow 60 crores. After 6 months, at the market rate, that is, you do separate transaction at the market rate at the rate of 8.8%, and you repay the borrowing, your interest cost will be 60 crores multiplied by market rate, a reference rate, which is 8.8%, 60 crores into 8.8% for 3 months. 60 crores into 8.8% for 3 months. So this will come to 60 crores, 8.88% for 3 months. So you will repay 1 crore 32 lakhs. 1 crore 32 lakhs. Okay, this is the outflow of interest cost under second option, under second situation. And what is happening in the forward rate agreement? Forward agreement, you have to pay 7,33,855. Now 1 crore 32 lakh is also your payment only. So 7.33 lakhs is payment, 1.32 crores is payment, both are payments, so we need to add. But one small problem there, that 7.33855 is happening after 6 months, whereas 1.32 crores interest payment is happening after 9 months. There is a time gap. So to fulfill the time gap, to make them comparable, we should apply time value of money. Means this 7.33855 you have to pay. So where will you pay? You borrow in the market and make the payment. So what will be this outflow after 6 months? That is, along with interest, will be 733,855 multiplied by 1 plus 0.088 into 3 by 12, along with interest at the market rates. So how much this will become? 733,855 into 1.022. 7,50,000. 7,50,000. So 7,50,000 you are going to make the payment, and 1.32 lakhs, 1.32 crores you are going to make the payment. So 1.32 lakhs plus 7.5 lakhs 1.32 crores plus 0.75 lakhs. So you get same number, 1 crore 39 lakh 50,000. Both are outflows. So you can add, you get 1 crore 39 lakh 50,000. Amazing, isn't it? In both situation, it happened to be 1 crore 39 lakh 50,000. 1 crore 39 lakh 50,000. And what will be the effective interest cost then? I'll write in the next slide. I hope you have taken down till here. Please take 2 minutes. Let me know if you have any still doubts. Any doubts on this? Okay. Now, what will be the effective interest cost? I will do it in the next slide. Two situation. So, effective interest cost after 9 months is what we calculated. So, here interest cost is both same amount only, 1.39 crores. Here also 1.39 crores. If you had space, you can continue. I did not have space, so I did not write below that. If you had space in the middle, you can continue below that. Okay, what will be the rate of interest? Okay, this they have not asked in the problem. I'm doing it as an extra thing. This they have not asked. So what will be the rate of interest? So 1.39 crores, 1 crore 39 lakh 50,000, 1.395 crores on 60 crores expressed in percentage into 100, and for a period of, this is for 3 months, how much for 12 months? Divided by 3 into 12. This also happens to be same number. So 1.395 crores on 60 crores to express in percentage into 100. This is for 3 months, how much for 12 months? So calculate how much will be the percentage rate of interest in percentage terms. I hope you are getting 9.3%. 9.3%, which is effectively, you understand, forward rate, right? Now, this explanation what we did is how the hedging will take place on net basis. This whole solution what we presented is how the hedging will take place when the settlement is on net basis. If the hedging is done on delivery basis, which means what? You will go to the bank, you will take the forwarded agreement, you execute it, and you pay 9.3% interest. So, hope you understand. This is same as forward rate if executed, that is delivery basis. Had you taken the loan after 6 months at 9.3%, and after 9 months you repay the loan at 9.3%, don't worry about the market rate. In delivery basis, the market rate does not matter. You would have paid 1.39 crores only interest. Ultimately, it happened to be the same. But we had to show the effect of FRA. That is why this whole solution is done on net basis. Okay, there is one small point. In the institute, they have done it in one exam. I don't agree with that, but I should explain that concept. That is, this FRA settlement happened on 6 months, right? This amount what you receive, amount what you pay, and then to make it comparable, we applied 1 plus R here, correct? From 6 months to 9 months, 1 plus R we multiplied. So that the time value of money is applied for them to make comparable. In one solution in the exam, only one solution in the exam, what they did institute, they did not consider the time value of money on FRA agreement. That means FRA agreement is taken as it is at the time of repayment also without time value of money. So what would be the rate of interest then? I would like to discuss. Just for understanding, I don't recommend you to present it in exam. Follow this method only. For your reference purpose, I'm telling you. If time value not applied on forward rate agreement. If forward rate agreement, time value is not applied. So after 6 months, so after 9 months, what will be your effective interest cost? Effective interest cost. Two situations we are discussing, remember. That is 1 crore 44 lakh, 1 crore 44 lakh minus, here we have taken 4 lakh 50,000. Don't take 4 lakh 50,000, take 4 lakh 39 453. 4 lakh 39 453. Similarly, here 1 crore 32 lakh, and we added how much? We added 7 lakh 50,000. Don't add 7 lakh 50,000, add 7 lakh 33 855. 7 lakh 33 855. If time value of money is ignored, I really don't recommend that, but I should explain you as institute has done it. 7 lakh 33 855. So what would be the situation then, and what would happen to your effective interest cost then? I would like to show the impact. 144 1 crore 44 lakh minus 439 453, 1 crore 39 60 547. That would be your effective interest cost. And 1 crore 32 lakhs plus 7 lakh 33 855, 1 crore 39 lakh 33 855. You see, it's not exactly equal to 1.39 50,000, but very close. 60,000 little bit more, 33,000 little bit less. It's very close. And why it is not exactly equal to 1.39 crores? Because of time value of money. If time value of money is not applied. Okay, and what will be the rate of interest then? I'm sure it will be very close to 9.3%. Very close. Follow same process. 1 crore 39 lakh 60,547 divided by 60 crores multiplied by 100. This is for 3 months. How much for 12 months? Similarly, this also 1 crore 39 lakhs 33,855 divided by 60 crores into 100 to express in percentage into 12 by 3. You get very close answer for sure. Let's calculate. Divided by 60 crores into 100 into 12 by 3, 9.289%. And here 139,60547 by 60 crores. . 9.307%. So you can see it's very close to 9.3% only, right? It's very close to 9.3. It's not exactly equal to 9.3 for the reason on the FRA settlement till the maturity we ignored the interest element, and therefore it happened to be slightly different. But at least for cross verification you should know the answer should be close to that. But of course, my point of view, this calculation is not correct because you have to consider time value of money. Anyway, just go through it, see if you have any doubts. Okay, let's go further. Okay, hope it is done. Since no questions, I'll go further. uh, I hope you got the question. So this kind of problem is very important from exam point of view. This is regarding the interest rate swap. So I hope you got this question. Let's read slowly. The problem looks very small, but application is very important. Lockwood Company has a high credit rating. It can borrow at a fixed rate of 10% or at a variable interest rate of LIBOR plus 0.3. It would like to borrow at a variable rate. Thomas Company has a lower credit rating. It can borrow at the rate of 11% or at a variable rate of LIBOR plus 0.5. It would like to borrow at a fixed rate. Using the principle of comparative advantage, explain how both parties could benefit from swap arrangement. Comparative advantage means relative advantage. Now regarding the swap, regarding the arbitrage, that is the how the it has to be interest cost has to be structured. I have explained it earlier, so please look at the steps for 2 minutes. Then we'll do this problem. Please take a look at the problem for 2 minutes. Look at the step. But anyway, what we should do first, write down the information in a tabular format. So one is Lockwood Company, and the other is Thomas Company. They were offered some fixed rates and some floating rates, some fixed rate and some floating rate. So what is the rate of interest is being offered? For Lockwood Company, fixed rate of 10% and a variable rate of LIBOR plus 0.3. I'll say L plus 0.3. LIBOR plus 0.3%. Thomas Company has a lower credit rating. It can borrow at the rate of 11%. So Thomas Company can borrow at the rate of 11%. And variable interest rate, LIBOR plus 0.5. Now, who is having absolute advantage? Look at Lockwood. For them, it is cheaper in fixed rate and cheaper in floating rates. But Thomas Company is paying higher fixed rate also. Thomas Company is paying higher floating rate also. Correct? They are paying higher fixed rate as well as they are paying higher floating rate. But how much extra they are paying? We can call a risk premium. How much extra they're having? They're paying 1% extra in fixed rate and they're paying a point LL cancel 0.2% extra in floating rate. They're paying 1% extra in fixed rate and 0.2% extra in floating rate. So Thomas Company is paying extra in both the cases. No doubts. But relatively, like both of you have failed, but relatively you got 31 marks, your friend has got 30 marks, you have got 1 marks more. So you have relative happiness in comparison, comparative advantage, comparative happiness. Similarly here, Thomas Company is paying 1% extra here and is paying 0.2% extra here, but among 1 and 0.2, which is relatively less costly for Thomas Company, the floating rate is less costly. Hope you're able to follow it. Less costly, and that is what is called as relative advantage. Relative advantage. Okay, so write down till there. Then we'll write down in the form of steps what we discussed during the theory stage. Okay, so relative advantage. Hope you have taken out this table. Okay, now what are 3 steps I told you? The first step is to calculate swap differential or swap gain, whatever it is. Swapping gain. Swapping gain. And what's the formula for swapping gain? Difference between difference. That is a fixed rate differential. Fixed rate differential minus floating rate differential. Floating rate differential. What is the fixed rate differential? 11 minus 10, 1%, or you can show like that only. Fixed rate differential, 11 minus 10 minus floating rate differential, LIBOR plus 0.5 minus LIBOR plus 0.3. So basically, that is 11 minus 10, and here you get LL anyway gets cancelled, LIBOR you cancel, 0.5 minus 0.3, so 1 minus 0.2, that is 0.8. That is nothing but what difference you are able to identify here. The bank is charging 1% higher in the fixed rate. Bank is charging 0.2% higher in the floating rate. They are charging high because the company have got a lower credit rating. That is justified. But they are not charging exactly equal. They are having slight difference. That is where we are trying to exploit. So 0.8% is where arbitrage opportunity exists through the help of swapping mechanism. And this 0.8 will be shared among what people they have not told you. So they have not told with whom this 0.8 will be shared. So we can just say 0.8 will be shared equally. When nothing is given, we always do that, right? Will be shared equally. That means 0.8 divided by 4, divided by 2, 0.4 each. Only two parties are there. If dealer was there, he would have got his share, like 10 basis points, 20 basis points, 0.2%. Remaining would have been divided among the two parties involved. That's the first step, swapping gain. Second step, identify the person or company with relative advantage, with comparative advantage. Company with comparative advantage, relative advantage, comparative advantage. And what is that? In this case, it is going to be Thomas Company. Why Thomas Company? Because they pay both of them high. Pay both, pay high rates in both the cases. Pay high rates, high interest. Pay high interest in both the cases. In both cases. But among them, they have got a relatively less costly. And they have got less costly. They pay both of them more only, but among the more, little bit less costly is floating rate, right? Because here they pay 1% extra and here they pay 0.2% extra, and therefore they have relative advantage by taking a floating rate, and this is our starting point. And third step is structure of the agreements. Structure of agreements. And what is the basic structure will be there? You will have one company and you will have another company. They go to bank. This company goes to bank. And if dealer is there, will the dealer also. And they have one swapping agreement. Correct? So that's what is going to happen. So one loan from bank. And this another company also take loan from bank. The arrow going out means you pay interest. Loan from bank, and between yourself you do a swapping agreement, swapping contract. One is this Lockwood company, other this Thomas company. This is the basic structure. This company goes to bank and pay interest. Another company also go to bank and pay interest, and they come to the swapping agreement, and then they swap among themselves. And we have to structure the rate of interest. We have to structure the swap agreement in such a way that they get their swapping gain, their share, how much? 0.4 each. But you will not get the gain directly. This gain will be achieved in the form of interest savings. Please remember that this gain will be achieved in form of savings in interest. savings in interest cost. So this swapping gain, you will not get a 0.4% profit directly. You will save in your loan interest cost. So write down till here. Let me know if you have any doubt. Okay, I hope you are able to do it till here. Now, what is the process here? You have to start with a company having relative advantage. Who has relative advantage? We already identified, that is company Thomas. That will be our starting point. And what they have advantage by going into the floating rate. So first you write the rate. They should go for floating rate. We'll come to the numbers directly. First identify the type of loan. In this case, fixed rate, floating rate. If it is a foreign currency swap, it would be like GBP USD, something like that. Okay, that is a starting point. If you want, you can write numerical. That's the first step. You take floating rate from the bank. And you take floating rate from the bank, another company will take opposites. So what this Lockwood will do, they will take fixed rates. So if you want to write numerical 2, second step, whatever Thomas is doing, they will do opposites by the another company. Starting point, Thomas will take a floating rate. Second step, other company, Lockwood, will do opposite loan from bank, which is a fixed rate. That is done. In swap, what you should do, you just exchange your position. What is the step in hedging and all I told you? You nullify the position and you create a new position. Now here you are paying a floating rate. Think from Thomas Company point of view, you are paying the floating rate. So if you pay floating rate, what should you receive? You should receive floating rate. You understand? You receive something and you pay something and that will be set off. Therefore, you will receive floating rate. I mean, I don't have to write receive. The arrow coming in, floating rate will come in. So arrow coming in is floating rates, and opposite will happen. That's what the swap is all about. The what you pay will be fixed rate. This you can write as step 3. This you can write as step 4. And now you don't have to think from the Lockwood company point of view. Even if you think, it will come to the same conclusion. You see, Lockwood company paying fixed rate, they should receive fixed rate. And they will opposite, they pay floating rate. See, they are paying fixed rate loan to bank. Whatever you are paying, collect it. You receive it. That position is nullified. Now you receive fixed means pay floating. You are supposed to do for Lockwood also if dealer was there. Now dealer is not there. Ultimately, it come to the balancing figure situation. Okay. Now we have to structure the interest rates. And while structuring the interest rate, keep it in mind, you have to achieve the swapping gain, the share of profits. But how do you achieve the gain? Not by profit, but by saving in interest cost. Right? So floating rate, how much you are going to pay floating rates? Floating rate, you're going to pay to the bank. Thomas Company floating rate, LIBOR plus 0.5. So you'll take LIBOR plus 0.5. Floating rate will be LIBOR plus 0.5. And what Lockwood Company will pay? Lockwood Company will pay a fixed rate. For Lockwood Company, fixed rate is 10%. So they will pay 10%. Now, you can think from Thomas Company point of view, or you can think from Lockwood Company point of view. Ultimately, what you have to do is balancing figure. Because one person you calculate, other persons will be automatically created. What alternative we should do? If swap dealer was there, then you have to calculate for this company and other company, the balancing figure would be for dealer. I hope you are able to understand. Okay, now think from Thomas Company point of view. You are paying LIBOR plus 0.5, receive LIBOR plus 0.5. Are you able to understand? You pay LIBOR plus 0.5, you receive LIBOR plus 0.5. Matter over. So that cash flow is nullified. That cash flow is nullified. You pay LIBOR plus 0.5, receive LIBOR plus 0.5. That is having zero cash flow impact now. Okay. Now, what Thomas Company is paying fixed rate? What is the fixed rate for Thomas Company? For Thomas Company, fixed rate is 11%. And what is that 11%? If you write 11%, your effective cost will be 11% because LIBOR plus 0.5, LIBOR plus 0.5, both got cancelled. 11% is what you will pay. But if without this circus of swapping also, you would have paid the same amount, 11%. Hope you're getting the point. So, you have to give some benefit. What benefit you should give? The interest cost will be saved. That is your share of swapping gain in this agreement. So 11% minus 0.4%. So Thomas Company will pay 10.6%. This will be the effective interest cost for Thomas Company. See, without this agreement, they would have paid 11%. With this agreement, they are paying 10.6%. Now you are saving 0.4%. Now, with respect to uh, the second person, we don't have to calculate again. This will be a balancing figure and you can verify. He will also save interest cost of 0.4%. Let us check it out. What is happening from second person point of view? Lockwood, he will pay 10%, he will receive 10.6%. He will pay 10%, receive 10.6%, and is paying LIBOR plus 0.5. So what is his effective interest cost at this point in time? Effective interest cost for Lockwood. So what he will tell, what is receiving? You are receiving 10%, 10.6%, and you're paying 10%, and you're paying LIBOR plus 0.5, which means totally you're paying LIBOR plus 10.5. So you're paying the LIBOR plus 10.5, receiving 10.6. So what will be the net amount? Pay minus receive LIBOR plus 0.5 minus LIBOR plus 10.5 minus 10.6. So can I say LIBOR minus 0.1? Effective interest cost, LIBOR minus 0.1. 10.5 you are paying, receiving 10.6. So you save 10.1, LIBOR minus 0.1. So how is a saving of point 0.4 achieved? I will tell you. What is his loan without this agreement, without this swapping circus? It would be Libor plus 0.3, and now is paying Libor minus 0.1. So from Libor plus 0.3, it is coming to Libor minus 0.1. So you're saving 0.4. From plus plus point 0.3, it's coming to minus 0.1. So you're reducing by 0.4. That is your saving. I hope you're able to get it. And that is how the effective interest cost is achieved. Ultimately, you'll get the marks for this effective interest cost. You can also compute from Lockwood point of view and balancing figure for Thomas. You see, you're paying Libor plus 0.5, receiving 10.6. So left to right side Libor plus 0.5, right to left 10.6. You can adjust this further. No, you can make plus 0.1 plus 0.1. Effect will be same, or minus 0.1 minus 0.1. So Libor plus 0.4 10.5, or Libor plus 0.3 10.4. You can set it off, or if you take out 0.5 here, this will become 10.1. Anyway, the outflow inflow, no. So you can do Libor plus Libor here and 10.1. That structure is left to you. How do you write? Whether you write Libor plus 0.5 10.6, or you write Libor and 10.1, that does not matter. Ultimately, this effect should be there. Go to the problem and see if you have any doubts. So in the exam, the answer will be effective interest cost. So the key thing here is to write down the steps. First identify floating rate, fixed rate, then come to the numbers. If you follow that process, this problem will be very simple. I hope you have done. I'll go further. This is an exam question in the old syllabus, January 2021 old syllabus. But now it is also part of the new syllabus question. In few attempts back, 1 or 2 attempts back, they have incorporated this type of question in the new syllabus study material also. So this type of question can come. So let me explain. Money market operation problems. Bank A enters into repo for 21 days with Bank B in 8% Government of India bonds 2020 at 6.1% for 5 crores. Assuming clean price of 97.3 and initial margin of 1.5 and days accrued interest of 240, assume 360 days in a year, compute the dirty price, the repayment maturity. Okay, it actually looks like a very new problem, but it's all what you know already, maybe at a intermediate level, but don't worry, I will explain. Full form of a repo means what? Repurchase offer agreements. Typical transaction. Let me take this problem itself. We have bank A and we have bank B. Okay. Now, how a loan transaction works? Suppose bank A takes loan today. Bank A takes loan today and Bank A will repay after some period along with interest. Repay loan. Repay later. Correct? That is a simple loan transaction. But whenever loan should be there, some sort of security should be given, pledge, hypothecation, some sort of surety will be given. So when you take a loan, for example, you give some gold as pledge. So when you take a loan, the bank A will give will give gold as pledge. Example purpose. Gold as pledge. Now when you repay the loan, what will happen to the gold? The gold will be returned, right? Gold is returned. Simple transaction. I take loan, I give gold as a security, and I repay the loan and I get back the gold. Simple process. Now, if the bank A defaults, does not repay, that to Indian context, very much possible. We have so many big example. Now, if there is a default, what should bank B should do? They have the gold, they will sell it. Now, can they sell just like that? No, they should go to the court, get the court approval because the gold is not in their name and then they have to sell it. It might be property papers, it might be some other hypothecation. To avoid this, you know what will happen in repo? You take loan and you give security papers. That is, you transfer, let's say, bonds or investment in bonds, you transfer to them. You repay the loan and you buy back. Are you understanding? You sell bonds and you get the loan. And once you repay the loan, you will buy back bonds. You might have the situation of buyback offer in your FR also. Anyway, I will not go there. Are you getting the point? I'm taking a loan by selling the bonds and with an agreement to buy back the bonds at the time of repayment. So what is the advantage of this instrument? The bank B need not worry if the repayment is not done. If the repayment is not done, bank B will not worry about bank A. Anyway, bond is in their name. They will sell in the open market and they get their money, whatever it is. So bank B is much more secured and the operations are much more smooth. That is what is called as a repo agreement. And that is what happens in real life between bank and RBI and between banks also many times. So they will give security. In this case, the bank A, what is happening in this problem, I'll tell you. Bank A is entering into repo agreement with bank B for instrument bonds. I told you what bond? GOI bonds. So what will they pay? They will sell Government of India bonds and they will take loan. They will take loan. This is what happens today. And later what will happen? Bank A will repay loan, and they will buy back the GOI bonds, buy back bonds. Now, don't confuse with too much of interest rate. This 8% government bonds is applicable on this bond instruments. But question is not about the bond, question about the repayment, the loan you have taken. The loan which you have taken will be applied on 6.1% on the loan you have taken itself. I hope you understood the structure of transactions here. And they also call what is happening today as a first leg and what is happening at maturity, repayment, as second leg. This is later. Repayment. They also call it as second leg. Okay. Hope you understood the structure of it. Now, they are using one term called as dirty price. What is this dirty price? Clean price. Clean price is nothing but X interest, excluding interest, not interest in your X. Dirty price is cum interest, cumulative of interest, including interest. So what is this X interest cum interest? Your previous life, IPCC, what is that? If I am a bondholder and if I am selling it to a new person, not only I am selling the bond, but the right to receive interest also I am selling. And we have discussed this in bond valuation also, but anyway. Now, when I'm selling to him on the maturity, on the coupon date, he will receive the entire coupon. Let's say I sold it after 3 months. He will receive entirely, though he is the holder only for 9 months and I'm the holder for first 3 months. I don't get anything, is it? So when I transfer the bond to the new person, I collect the money not only towards the value of the bond, but also towards the coupon. For how much? In my example, 3 months is what I am holding. Therefore, what is this dirty price equals to? Dirty price is clean price plus interest accrued till date. That is, I'm a holder for 3 months. So until 3 months, I have the right to receive interest. You pay me that also. Then only I will sell you the bonds. I'm sure you would have learned and forgotten what you would have learned in IPCC level. Anyway, so let's write down first. The dirty price is given by dirty price is nothing but cum interest. This is given by the clean price, which is nothing but X interest, purely about cost of the bond, plus interest accrued till date. Interest accrued. So clean price 97.3. Now interest accrued is not on the loan you have taken, is on the bonds, that is at 8%. So interest accrued, face value nothing is given. We'll assume it as 100. Face value assume as 100. Usually it will be 100 only. That's why 97.3. Close is 100 only. So on 100, you apply 8% for how many days? They have given 240 days. Assume 360 days in a year. So into 240 by 360. 5.33. So 102.63, I think. $102.63. Okay, then I'll calculate repayment. For repayment, I'll calculate the first leg, means amount of loan taken. Amount of loan, it's called as the first leg. It's given by whatever the nominal value, that's the loan amount you want to take, nominal value multiplied by the dirty price by 100. That is the amount of loan you take, and sometimes entire amount is not given. They said initial margin of 1.5%, that will be deducted. To that extent, loan will not be given. So that is 1 minus initial margin. 1 minus initial margin. So nominal value is 50 crores, sorry, 5 crores into dirty price. We have calculated 102.63 divided by 100 into 1 minus initial margin. Initial margin is 1.5. So 1.5% will not be given. Only balance will be given as loan. Like you will also maintain some margin, right? You understand? If gold value is 1 lakh, they will not give you low gold of 1 lakh value. They will always keep a safety margin. In this case, 1.5%. So 1 minus 0.015. So 5 crores into 102.63 by 100 into 0.985, I think. 5 crore, 5 lakh, 45, 275. 5 crore, 5 lakh, 45, 275. 5 crore, 5 lakh, 45, 275. Okay, so this is about the amount of loan, first leg. Then amount of repayments. That is what second leg. Okay. That depends on your agreement. How much loan you are taking for. Your interest is 6.1% for 21 days. So this will be 5, not 5 crores, 5 crore, 5 lakh 45,275. This is the amount of loan you have taken, and you will pay interest of 6.1%. And on that, for a period of, you're taking loan for 21 days. So 21 by 360. They said take 360. So 5 crore 5 lakh 45 275 into 0.06 or into 0.061 6.1% into 21 by 360. 1 crore 79 lakhs, so 1 lakh 79 857. 179 857. So what will be repayments? Loan you have taken 5 crore 5 lakh plus interest 1 lakh 79. So repayment will become 505 45 275 plus 179 857, or you can do directly 1 plus R also. 5 crore 7 lakh 25,132. 5 crore 7 lakh 25 132. Okay, hope you've taken down. Okay, let's go further. This is an exam question. I hope you got it. Let us read. A textile manufacturer has taken floating interest rate loan of 40 lakhs, rupees 40 lakh on 1st of April 2012. The rate of interest of the inception of the loan is 8.5%. Interest to be paid every year on 31st of March. And duration of the loan is 4 years. In the month of October 2012, the central bank of the country released the following projections about the interest rate likely to prevail in future. On 31st of March 2013, first year actually, on the day prepayment, 8.75, March 14, 10%, March 2015, I think that's it's not given printed correctly. It should be 31st March 2015. 15 is missing, just correct it. March 2015 at 10.5%, and at 31st March 16, 7.75%. Show how this borrowing can be hedged, the risk arising out of expected arise in the interest rate when he wants to peg his interest cost at 8.5% per annum. Assuming that premium negotiated by both the parties is 0.75% to be paid on 1st of October 2012, and actual rate of interest on the respective due dates happens to be 31st March 10.2, 31st March 14 11.5, 15 9.25, and 31st March 16 9 and 8.25. Show how settlement will be executed on the prospective interest due dates. Okay, now what is his present position? He has taken a position, present position of, he has taken floating rate loan. Okay, let me write those things. So we have it. Okay, position is borrower, and you are worried about increasing the interest rates because you have taken floating rate loan. Had you taken fixed rate loan, you would not have worried like this. So because you have taken floating rate loan, you're worried about increase in the interest rates. And projections are also given. Remember, on 31st March 2012, the projections, central bank has given projections, it is likely to be 8.75 at 10%, 10.5 at 7.75. So, as per the projections of the bank, the interest is likely to increase. You have taken at 8.5, you are worried. And today, I mean, recently also that is happening. In fact, yesterday night, many people are looking at US bank MPC, central policy, the monetary policy, because they are expecting whether the US Federal Bank will increase the interest rates or not. That will affect the whole world. And how it will affect the borrower like this. You can look at RBI and say whether they will increase interest rates. If they do increase interest rates, you are a floating rate borrower, you are worried, you have to pay more interest. You are worried here. So what you should do? And he wants to peg his interest cost at 8.5%, of course, excluding premium. What is pegging this interest cost? This pegging interest cost means you want to fix it. Fix it. Don't think about peg something. Something. Peg means you want to fix the interest cost. So what you have to do? If you want to peg the interest cost at 8.5%, if you don't want to exceed beyond 8.5%, you enter into interest rate cap option. You enter into interest rate cap option at the rate of 8.5, so that even if the rate exceeds 8.5%, you don't have to worry, because the intrinsic value will come to your pocket, because you are a option holder, cap option holder. So even if interest rate increase, you don't worry. This option will compensate for your loss. Of course, it will have the cost of premium. The premium amount is 0.75%. So excluding cost of hedging, excluding that premium, your interest cost will not cross 8.5%. You take a call option, you take a strike rate at 8.5. So if it becomes 8.6%, 8.6 minus 8.5, market rate minus strike price, market rate minus strike rate, 0.1% will come to your pocket. And if it becomes 10%, you don't have to worry. 8% minus 8.5, 10 minus 8.5, 1.5% will come to your pocket. So even if you pay 10%, 1.5 recovery you will get with the help of cap option. Your interest rate will be capped at 8.5. If rate of interest is below 8.5, like say 7%, 8%, option lapse, and you will pay the actual interest. That you don't have to worry. You will pay the lower interest. Yes, the premium will be the cost of getting this option. And 0.75% premium, I assume it is to be one-time premium. But this is valid for how many years? You are paying one-time premium for how many years? Usually you pay premium every time you make the repayment. This loan is for duration of 4 years, and you have to pay interest every 31st of March. So every year for 4 years means year 1, year 2, year 3, year 4. You need 4 interest payment. So you need 4 option contracts. But you will not enter into 4 option contract. You will enter into one time and to be settled at the end of every year for 4 years. And for entire 4-year contract, you pay one time premium, that 0.75%. And 0.75% premium is one time. But I have to spread across 4 contracts, 4 repayments. I should divide by 4. Of course, I will not divide by 4. I will divide by annuity factor at 4%. In fact, that is also not given. In the problem, you can say it is subject to premium. You can also say like that, but anyway, it does not matter. Okay, anyway. To be allocated among reset period using annuity factor, but anyway, that is fine. Just say that 0.75% is the premium to be paid. Okay, so here we'll have reset periods or repayment amount, whatever it is, repayment dates, what and all you are going to do, what will be your interest costs under current agreements, then what will happen to your option intrinsic value, net interest costs. Okay, one time premium 0.75% of how much you pay at the beginning itself. Amount of loan taken 40 lakhs, 40 crores, 40 lakhs. Okay, 40 lakhs into 0.75%. 30,000. This is one time premium. You don't have to assume to be. It's one time. They are not very specific, so I assumed it. But you should understand as one time premium. 30,000. So you become cap option holder. Okay, you become cap option holder. Okay, what are the dates you have? 31st March 13. 1/4/2012 you have taken the loan. So repayment dates 31st March 13, 31st March 14, 31st March 15, and 31st March 16. Okay, and you don't have to worry about the projections in the sense this first sentence you don't worry, this first paragraph. This is just to showcase the fact that he is worried about the increase in the interest rate. He is a floating rate payer. The bank is telling, RBI is telling, we will increase the interest rate in the future. We are projecting higher interest rate in the future. So, being a floating rate borrower, you're worried. That's worry is established in the first paragraph. This first point. But actual interest rate you will come to know only next. Assume that premium negotiated, the actual interest rate on respective applicable for respective data happens to be 10.2%. So that is what you will take. Actual interest rate for actual payment. So 10.2%, 10.2, 11.5, 10.2, 11.5, 9.25, 9. Huh? How much is they giving? 31st March 15 and 16. 2% they are giving. Okay, 10.2, 10.2, 11.5, 9.25, 8.25. Okay, this 9% something is, I don't know why, I think it's a typing mistake. You can't have 2% on same rate, just take out this 9%. You just say at 8.25. 9.25, so 9.25 and 8.5. 9.25, 8.25. Just take out this number here. This 9% is typing mistake. Take out that 9%. The material, that 9% is there, just you take out that. It is at 8.25%. That's a typing mistake. So 10.2, 11.5, 9.25, 8.25. So 9.25, So repayment dates, interest cost, then intrinsic value in option, then effective interest cost. Repayment dates, 31st March 13, 31st March 14, 31st March 15, 31st March 16. Interest cost, uh, actual rate only relevant, 10.2, 11.5, 9.25, 8.25. I think these are the interest cost. Okay. Now, this interest cost you pay like 40 lakhs into 10.2%. Yearly once you pay 40 lakhs into 10.2%, 4 lakh 8,000. 4 lakh 8,000. Similarly, 40 lakhs into 11.5%, 4 lakh 60,000. And here 40 lakhs into 9.25%, 3 lakh 70,000. And 40 lakhs into 8.25%, 3 lakh 30,000. And remember, the strike rate is 8.5. So when the option is exercised, when the reference rate or market rate is greater than 8.5, this call option, C for cap, C for call, cap option is exercised. Okay, now 10.2, 8.5, yes, exercised. 10.2% minus 8.5, exercised. And on the amount of loan, 40 lakhs. That will be the lot size also. And this also exercise 11.5 greater, 11.5 minus 8.5% into 40 lakhs. And 9.25, yes, more than 8.5, you will exercise 11.5 minus 9.25 into 40 lakhs. And 8.25 here, not exercised. 8.25 is less, so 0. Option will lapse. 8.25 is less than 8.5. Market rate is less, call option not exercised, cap option not exercised. So 10.2 minus 8.5, that is 1.7% of 40 lakhs, 68,000 you will receive. And this 4 lakh 8,000, of course, interest cost you will pay. So 11.5 minus 8.5 into 4 lakh, you receive 1 lakh 20,000. And 11.5 minus 9.25 into 40 lakhs, 90,000 you receive. And here 0 rupees you receive. So what will be your effective interest cost? 4 lakh 8,000 here, 68,000 here, 4 lakh 8,000 you pay, 68,000 you receive. So net cost 4 lakh 8,000 minus 68,000, net cost 3 lakh 40,000. And here also 4 lakh 60 minus 1 lakh 20, 3 lakh 40,000. and 3,70,000 minus 90, 2,80,000, 15 of 11.5 minus 9.25. So you get 2.25. So 8.5, right? 8.5. Yeah. We should. Okay, 9.25 minus 8.5. Sorry, that's a mistake. 9.25 is correct, minus 8.5, like the earlier. So 9.25 minus 8.5 into 40 lakhs. 9.25 minus 8.5 into 40 lakhs. So you get 30,000. Okay, 30,000, yes. It's not 90,000, you receive 30,000. So 3,70,000 minus 30,000 you receive, that will also be 3,40,000. And this is 3,30,000 minus 0, 3,30,000. This is your effective interest cost. And what is this 3,40,000 if you imagine? This is nothing but your strike rates. You see 3,40,000 is the amount of interest you're paying on 40 lakhs for express in percentage terms. So how much interest you get? This is only 1 year. So no time adjustment. 3,40,000 by 40 lakhs. You get 8.5%. That's what your objective. The person wanted to cap his interest rate at 8.5%. Yes, you could achieve. Of course, this is subject to premium. That premium cost will be there. This 30,000 will call as cost of hedging. But every year you could ensure your rate of effective interest is not crossing 8.5%. And how could you achieve it? With the help of interest rate cap option. And there is one more calculation which is being done. It is applied in some problems. I'll show you that as well. You need not solve it. This much is sufficient. But I'll show you that also just for your reference. First you take down till here. Okay. Hope you have taken it down. I'll take it out. What I was telling you is, if you want to show effective interest cost with premium, then what would you show in exam is this. This 30,000 to be spread across all these 4 payments, because premium payment is one time here. So I should divide by 4. I will not divide by 4. I will divide by annuity factor. You understand, right? Because divide by 4 is a without time value of money. So 30,000 divided by annuity factor at 4, and thereby you can express premium on percentage basis. So reset dates, market rate, intrinsic value, this number we already calculated. I just showed you 68,000, 1,20,000, 0, 30,000 and 0. You know it already. Premium, the cost of the premium for the holder, I will take it as extra interest cost. So 9159 is what will be there for every year. It's as if I am paying every year. So my payoff will be intrinsic value minus premium, 68,000 minus 9159, 1,20,000 minus 9159. Like that you get payoff. Interest on loan, that is at the rate of 10.2%, 11.5%, 9.25%, 8.25%. Then effective interest cost with premium will be 4,08,000 you pay, 58,841 you receive, net amount 3,49,159. 4,60,000 you pay, 1,10,000 you receive, 3,70,000 you pay, 20,000 you receive, 3,30,000 you pay, and 9,159 you pay effectively, because minus means you pay 3,39,000. So what is this 3,49,000? Previously we got 3,40,000, right? What is this 9,159? Nothing but premium. So you already calculated 3,40,000 plus 9159. That will be the cost along with the effect of premium. You don't have to take down like this, but sometime institute might give solution like this in some other problem. So there you just have to be careful. Just for your reference, I showed you the solution like this. Along with premium, your cost will slightly increase. Of course, nothing comes free. You have to pay cost of hedging. This premium will become your cost of hedging. Okay, so that's about this exam problem.